Dr. Ford, you wanted me to make sure we covered that, where we got it going. I think if you look back, I know the process of learning is painful and difficult, but I think if you look back to where you were 4 weeks ago, a lot of you with Excel skills and with models, and where you are now, you'd be surprised at how far you've come, and you probably wouldn't have thought that you could have come this way, right? Right, Isabel?
Oh, yeah.
Is that what you were saying? That's exactly what you were saying. Okay, so you know, we still have, including today, 4 more learning sessions, learning opportunities in class, plus the balance of the work during the week. So I'm reminded. I don't have it. Would you like to share that with the class, Isabel?
No, actually, I was just talking about the
Okay. All right. Well, if you've got a question, you can ask. Thank you. I used to read it at like 5th or 6th class of the term. I used to read something that was really a reminder to me as an instructor to try to get the students, you know, charge from the students, right? So, like, at the end of the day, my goal is to try to get everyone to learn. At the end of the day, that's what makes me, or should make me, effective. If you take it upon yourself to, you find the material, the manner in which it's presented interesting enough. And from that perspective, I think some in the class have really taken to the material. I see it, I hear it, I get the comments, I see the improvement. Others, not so much. And so I understand that the material in this class is not as relevant or applicable for everyone. But the one thing that I said at the beginning, you're paying good money for the program. And the goal is to walk out of here with as many tools in your toolkit as possible. You know, someone said to me the other day, well, you know, and again, this is, I'm getting old and I look at life maybe a slightly different way. Well, if your boss tells you to do something, you just get you know, you don't know how to do it, you just ask one of your fellow workers. Your fellow workers want your job, okay? You know, at the end of the day, it's a dog-eat-dog world, right? So our goal is to try to be the most prepared dog as possible. That's why we're here, to try to get all these, you know, tools, right? I mean, one of the most embarrassing things for me has nothing to do with academics. I went to visit one of my sisters in Egypt many years ago, and I had to get a stupid, you know, Fedor's guide to figure out about all the ancient, you know, Egyptian history I should have learned in 8th grade when I wasn't paying attention. When I was sitting in the back of the room talking to the people next to me and not paying attention to the instructor. And I had to buy a stupid tourist guide to figure out. So I felt like the dumb American. I was like, okay, here I am, right? I should have paid attention when I had the opportunity to learn. Okay, so anyway, it's just my encouragement to you to take advantage of what the program offers. I understand not all of you have the same background, not all of you have the same training, not all of you have the same need for some of these tools. But frankly, some of the simple tools that we did in last week, figuring out, and I'll go through the exercise, present value and future value and payment and rate with Excel, are as important as they are in doing it in Dr. Forgey's class with your little 12C. Okay? Those are things that anybody in any career, I mean, just to calculate a mortgage payment for your house or to amortize a mortgage, you're going to go buy a house, somebody's giving you a fixed rate versus a variable rate option. Now you can do sensitivity analysis, right? So, anyway, I only brought one article today, and that Panattoni's a developer. They bought a site on Gratney, which is 119th Street. It's a 10-acre industrial site. They paid $25 million for it. It's a 20-acre site. They paid $1.25 million an acre, or $28.75 a square foot. They can actually cover this thing like 47%, okay? So I still don't have the information from Foundry, one of the deal we looked at the other day. One of the 2 parcels they took down is listed. It was only listed at $15 a square foot. So there might be some issues there. I don't know. Maybe the coverage has something to do with that. That accounts for about $8 of difference. But anyway, so it looks like industrial land in South Florida. If you can get it, it's going like at $25 a square foot. So it wasn't far off what we were talking about the other day. Jose Pablo brought me an article from last Sunday's New York Times, and it talks about digital printing. and in particular the use of digital printing for fabricating homes and for fabricating affordable homes. And I thought to me, what caught me the most as I read the article here, it said this is trying a new approach to a process largely unchanged for centuries. And the reality is the whole construction process, the development process is relatively static. It hasn't really changed that much for a lot of years. There's I forget the name of the company, it's a startup, but one of the guys that started Applied Materials and then was one of the founders of Tesla has started a company, I can't remember the name of it now, but it is a fully integrated multifamily development business. And when I say fully integrated, they not only design, but they're manufacturing all the stuff on a prefab basis now. So they're, you know, it's all modules, you know, so all the kitchens are sort of being prefabbed somewhere in Phoenix with all the cabinetry, everything, and it's just being trucked, and all it does is get assembled. And their whole rationale is we've got to change the process of manufacturing. Those of you who are architects, those of you who are construction people understand the difference between when you draw something and when you get on site and you got to deal with conditions, and you got to deal with personnel, and you got to deal with weather, and you got to deal with delays in materials. And all of a sudden these people are saying, hey, let's try to take as many variables as we can, and as a consequence, cost out of the system. So, you know, might they be successful? I don't know. But it's a novel thought to try to take cost out of the system. At the end of the day, it used to cost $49 to buy a share of stock. It's free now, right? It used to cost you, you know, it used to cost the provider 10% of an airline ticket or 15% of a cruise to book it. Now, you as a consumer didn't pay it, right? But the agencies were getting those commissions. That's all gone. So there are processes that have taken a tremendous amount of cost out, right? You could probably go through, my 12C, this is like the 4th or 5th that I have. I think the last one I bought cost like $69. Well, the first one I bought in 1982 cost like $99. So you figure out all these years later, with inflation, why this is cheaper. Now, the way we've gotten cost out is we've exported a lot of the jobs and all that. That's a whole other political conversation. But the, you know, the goal at the end of the day is to take cost out of the system. And maybe we can find a solution for affordable housing with this, you know. So there's a whole bunch of other sort of issues here, you know, involved with it. But a very interesting article, so thank you for bringing it in. Okay. Do we have any other comments before I want to pick up on the due diligence? So I want to cover diligence, and I want to cover the whole issue of bankruptcy and securitized mortgages. Is there any questions or anything on the reading or what we covered last week before I go back to it? No? Okay. So I had given you, last week, I had given you some different guidelines or concepts on how to go about a diligence process. And in particular, I sent some checklists to you that you can use as a guide or as a tool. And then I went ahead and gave you what sort of conceptually a friend of mine and what I would put together. I can't find mine, but it doesn't really matter. Doesn't really matter. So, but ultimately it was a process of going around and trying to understand all the different facets of evaluating and ultimately evaluating the risk in undertaking an acquisition of an asset. Now, we've focused it on real estate. You can always extract that or extrapolate that to a business, right? At the end of the day, in real estate, what are we buying? We're buying a financial asset. If we're buying a financial asset, what's at risk? The cash flow, right? So we want to make sure, above all else, that that cash flow is protected and secure. There are other things we need to take a look at. We're buying a structure. What's the condition of the structure? The envelope, the contents, the systems inside. What's the legal status of it, right? What's the surrounding market tell us, right? So ultimately, there's a lot of different ways to look at it. And we had kind of walked, I think when we finished last week, we had pretty much walked through, we've gone through a leasing, understanding the market from a leasing perspective and from a sales comp perspective. We've gone through all of the different steps that one would take at looking at the physical building. We've gone through legal review, and ultimately where we wound up was, okay, what I called closing. Now we've gotten I laid out for you what a hypothetical timeline was. It isn't always like that, but that's just the way it is. It's relatively quick. Now you get the go-ahead. Now you're the winning bidder. Now what do you do? Okay, so, you know, one of the steps I put investment committee review. Now, you may work in a family business. You may not have a formal investment committee. Maybe you just got to get together with your brother. Maybe you got to get together with your wife. Maybe you got to get together with your father. Maybe a bunch of brothers got to get together. Maybe it's an informal process. But there's got to be a vetting process ultimately when whoever's undertaking the diligence sits down with somebody else and has a reality check and says, hey, do we move forward or not? This morning before I came in, I'm on the investment committee at Fordham. We've got a call on Friday. We're taking a look at 2 potential private equity investments. And you know, ultimately, what are we doing? We're vetting what the CIO and what management want to do. They've spoken to a consultant. They've got some potential investment opportunities, and they've walked through what's the investment entail, what's the return profile look like, what's the history look like, what are the potential risks, what are the potential upsides, what is the fee structure associated with this, right? And ultimately, we're gonna approve it or not, okay? And so that really needs to happen in almost any environment. I will share with you now. I'm going to pop open something that I did, which could emulate, in fact, what an approval process could look like. There are a series of, so when you're ready to close, so one, you got to put it all together to get the buy-in from your people, okay? And your people, as an extension, is going to include equity partners, and it's going to include creditors. So you got to get buy-in from the capital stack, right? At the end of the day, you're buying an asset, but you got to get the approval from a creditor who's going to finance the deal for you, and you got to get your partners or your bosses to buy in on this. There's a whole legal process that goes on. And again, I recommend it. Find the best consultant that you can in every area. Get the best attorney that you can. There's a whole series of things you need to do. Prepare a bill of sale. You need to assign leases. If there's trademarks or any other intangible, you got to get those assigned, right? You got to get the whole title done, right? You know, the affidavit. If you've got foreigners involved, you got to get all the paperwork involved. You got to get deed. You know, you got to get the deed prepared. And ultimately, it all leads to a closing statement or a settlement statement. So ultimately, you're going to get to a point where it all comes together. Now, who's bought a house here before? Who's bought a house? A lot of you bought a house. What happens when you buy a house? Okay, you go to a title agency, and what do? You close on your loan. You close on your loan, or you close on your house? House. Okay. Okay. So closing is like a physical and a sort of time event. Well, it's a physical event and it's a time event. So you go somewhere to convey something, right? So in your case, you mentioned 2 things that you may convey at closing. You may convey title, and you may close on a loan. You may get the actual funds from part of the, right? You may bring your equity. You may bring your equity, right? You may send into an escrow agent, right? You may send into that title company that's working as an escrow agent. You know, you're buying a house for 100, and you got to put in 20, so you're going to wire the 20 to them, right? And they're going to hold it, right, till you get your title, right? And then who's going to send in the 80? The bank, right? And then somebody there is going to say, hey, it's all the paperwork's done and everything. Boom. We're going to send this guy 100, and this guy's going to give you a deed. Okay? Something like that, right? And it's all pretty structured in a house. There's like a thing called, I think you call it now, settlement statement. It used to be called the HUD-1. What's it called now? Do we have any residential brokers here? No? What's it called? Settlement statement?
It's a HUD. It would just be the HUD.
Well, it used to be called the HUD-1 was the form. They call it something else now, but it doesn't matter. There is a form which the Department of Housing and Urban Development says for all residential transactions in this country, this needs to be the summary where all the parties that are involved in a closing, you know, see what happens, see the details. Well, in commercial closings, we don't have that. There is no HUD that overlays everything. There is no outside party that says, okay, what do you do? You know, who gets what? But we do need to have the same process, right? Money's coming in, money's going out, expenses need to be paid. What do? Who does all this?
Your attorney.
So, what's escrow?
A platform,
What's a platform?
like an information technology system, and it's just like a broker. The escrow is holding the money so that both people can have assurance.
Okay, let's
that-
ask one question at a time,
Okay.
because you just used it. What's an escrow?
Bank account?
It's a bank
a
account.
third party, a facilitator.
A facilitator. So, John, do we have a more correct legal description that you want to use?
It's similar to like a trust account where you hold
Okay,
funds.
so it is a separate account somewhere, okay, at a financial institution somewhere, that where the funds are held exclusively for the benefit of a third party, okay? So an escrow is not a business, an escrow is not a place, it's a type of structure, it's a type of account where funds are placed and they're not supposed to be, you know, they're not supposed to go out, they're held there in safety, right? Is that a good way?
Is
Okay.
escrow, is it the funds or like the account? Like, or would you specify escrow funds versus escrow?
Well, you could say funds that are escrowed, right? So people say escrow funds, but people are talking about funds that have been put into an escrow account. So who can hold an escrow account? An attorney might hold an escrow account, a
Escrow.
title,
Escrow.
an escrow agent, a title company, okay? Okay, so somebody, so if I want to pay this guy, but he's got the title, I don't want to give him the money up front, right? But I got to facilitate it somewhere, so I got to send it to some third party that says, hey, when everything clears, you can send the guy the money. He also doesn't want to give you the title till he gets all the money, right? So you get this, what Chase just called a facilitator. You have an intermediary that functions as the go-between, the clearinghouse between a buyer and a seller. In this country, yes, it could be an attorney, but in this country, I'll tell you, and correct me if I'm wrong, most commercial transactions are handled by title companies today. So I don't know on the residential side, there may be some attorneys that still do that, but I know in commercial transactions, title companies tend to offer as part of their services to function as the closing agent. So, well, this is great. So closing is the one time, it's the one moment where all the information that's related to a closing or related to a transaction comes together, okay? So there is no form in commercial transactions. There is no legally mandated or stipulated way to do it, okay? It used to be that closings would take several days sometimes. People would go into a conference room somewhere. People would argue, throw things at one another. You'd say, oh, I'm missing this, I'm missing that. You call the bank says, I'm missing this paper. It's all done electronically now. So there's not a platform to do closings, Chase, to your point. There isn't specifically a platform, but it's all done electronically, okay? And so I haven't been to a physical closing in 20-something years. Let me see how. I'm sorry? Okay. Thank you. That doesn't. I used to do a case study. In fact, some of you may have done a case study on a closing statement. Those of you who've taken the accounting class with me. But I want to show you what a closing statement looks like, and we'll go through some of the concepts so you can see the things that we have to deal in a closing, okay? Okay, so this is actually the solution set from this case study that I used to do, but this is based on a real life transaction that we did in Orlando, well, just north of Orlando in the Maitland submarket. sometime around 2007, 2008, sometime in that time frame. I don't remember exactly. It must have been 2008. In fact, I think that's the right date, June 13th. I don't know why I can't get this. So you guys can't see them. I'm trying to get. Can you guys see that? Yes, no?
Yeah.
Yes.
Okay, so a closing statement. First American, there's two large title companies in this country, Chicago Title and First American. They're publicly traded. There's a lawyer's title is a relative. Is that the third? I don't know who else is after that, but they're the ones who do it. What does it include? Property name, who the buyer is, who the seller is, right? It's typically time-stamped. This is critical. Date and timestamp. The things I went over in the video this week was how to date stamp your Excel files. Because in this particular closing, you're going to see there were multiple, even on the same day, there were multiple transfers that we made. Because every time we got a closing statement out to all the parties, something else popped up and we had to send more money and send more money. Okay, so you ultimately want to say we're closing with this version, okay? The version at so-and-so time, okay? The concept of closing statements, for those of you who haven't worked with them, talk with inside of buyer and credit side. Now, a commercial closing statement could be a buyer-only statement, or it could be a seller-only statement, or it could be a combined. I'm showing you a combined statement in which both all of the transactions related to the buyer and to the seller are shown. Sometimes buyers and sellers don't want the other party to see all of their transactions. There may be things that they're paying out of escrow or out of that closing that they don't want the other party to find out. In fact, this particular actual closing was not a combined statement. I did this for the solution. We had we as buyers had our statement and the seller had their statement. And why? Well, you'll see down below the seller was paying like $1.5 million commission to somebody and they didn't want us to know. It was a publicly traded company we were buying from, but apparently they didn't want people to know. I eventually got a hold of it, not because I thought there was any malice, I just needed to see something. So anyway, so the concept, we talk about a buyer and a seller's closing, and we talk about the concept of charges, and we talk about the concepts of credits. This is not the same as an accounting concept of a debit and a credit. The way I would say it is, typically the best thing would be to say that a charge is something that is going to cost, if you may, the party, and a credit would be something that would inure to the benefit of that party. Okay? There are items that only impact one party in a closing. There are items that may impact both. Okay? And I want to go through some of these items so that you could see how a closing statement works. And ultimately, we need to be familiar. There will be a time when you will buy an asset, the culmination of the diligence process, is that you get to close, okay? And ultimately, this is what summarizes all the cash coming in and all the cash going out of a transaction. And you say, why is that important? Well, if I'm an appraiser, if I'm a surveyor, if I'm an attorney, if I'm a bank, when am I going to get paid? I want to get paid while there's cash. And the only time that I know there's cash is at closing. Okay? So anybody that's got anything to do with a transaction is going to want to get paid at closing. Oh, no, bill me later. No. I want the money while it's hot. Money talks and cash screams. Okay? So, let's take a look at the purchase price, right? So purchase price is a charge to the buyer and a credit to the seller. Right? It's a credit. It inures to the benefit. If there was nothing else to deal with here, the buyer would have to pay $39 million and the seller would get $39 million. Right? So this is an item where you've got items on both sides. Okay? Now, as a buyer, we make deposits. That's common. Okay? As a buyer, it's common to put some sort of deposit, to put money in escrow, to have escrow funds. So, what we talked about earnest money the other day, it goes into an escrow account somewhere, and that money will be brought into the closing at the time come in into the pool of money to be distributed to whomever at the time of closing, okay? We prorate items. So what are prorations?
So like divvied up per unit from a larger quantity and price
Okay, but let's put it in the context of a real estate. So I own
per square foot potentially.
I own an apartment building, typically done on time, not on square footage. Because what happens? We close this transaction the 13th of June. I've got expenses going on throughout the month, right? Who's responsible for what? So, you know, as buyer and seller, you can agree to anything you want to agree to in the contract, okay? But typically what's going to happen is those first 13 days of revenues and expenses are going to accrue for the benefit or to the detriment of the seller, and the subsequent 17 or 18 days are going to accrue for the benefit or the detriment of the buyer. Does that make sense? If I collect 100 in rent and I buy the building on the 13th, I should only be entitled to 17 over 30 of that, right? Does that make sense? So rents can be accrued. Property taxes is a big proration. It's a big proration. Why? When are property taxes typically paid in this country?
Once a year.
Once a year. When do we typically pay them?
November.
Okay, so you can prepay early. So they're typically in Florida. They're payable at March 30th or March 1st. Okay, in March. March. But there's a prepay. We can do the thing. We can do the math. You get a 4% prepayment penalty. Prepayment discount if in November, 3 in December, 2 in January, 1 in February. So March 31st. Okay. So, but what happens is on June 13th, you don't know what the assessment is. Okay. So the seller is responsible for almost 180 days, right? 163 days worth of property taxes, but it hasn't been paid. So you need to make sure that he's charged for that. Right? Does that make sense? I'm not going to get into this particular, there might be TIs or deposits. So in commercial transactions, there's typically deposits, right? There's not as much as in residential, in multifamily. But deposits that are held by a seller need to be transferred to the buyer, right? Because the buyer's the one who's got, continues with the obligation under the lease, right? So we've got a prorate them. So basically what we're saying is, okay, we're going to take money from the seller here and make sure that the buyer gets appropriate credit for that. In this particular case, there were different transactions, different commissions. So these people are paying $1.5 million to a related party. Typically in investment transactions, there are no buyer commissions. We had actually engaged, this was an off-market transaction, we had engaged a broker to seek out willing sellers for us. And so we agreed to pay them a fee if, on a success basis, if they actually found deals that we closed, okay? So, there was debt assumed here, okay? And so when you assume debt, it kind of works, in the same way. You've got to charge the seller for the outstanding loan balance. How do you get the outstanding loan balance? What do you get? What do you get from the bank? We talked about this last week.
Estoppel letter?
You get an estoppel letter from the bank, and the bank tells you what?
What people have been paying, like all the tenants have been
Or what's overdue.
From the bank, how much is due? How much interest per day, right? If it were an estoppel related to a lease, what would it involve, Chase?
the tenant leases.
So what lease is in place? So there's a tenant making an affirmation now saying, I'm under obligation under this lease, this is the rent that I pay, this is the space that I occupy, the landlord is in compliance or not. Yes, Kenny?
I think I misunderstood you. You said for the bank, you if you're assuming the loan, or you just
this was an assumable loan, yes.
oh, okay.
So because it was an assumable loan, right? The seller is now got to essentially pay off the loan at closing. So what he does is he says, okay, I owe $20 million. That's $20 million less that I get. That's a charge to me. And it becomes a credit to the buyer, because now the buyer assumes that obligation. So now that debt is owed by the buyer. Okay, now you need to get approvals, you know, the loans don't just get, we'll talk about CMBS as a securitized loan. You don't just have an arbitrary right to assume loans. There's a process you need to go through, okay? There were legal fees, and then there were some reserves that were established with the seller, with the financial institution that needed to be transferred from the seller to the buyer.
And the loan's getting paid off right now, though.
I'm sorry?
The loan's getting paid off.
It's
right
not getting paid off, it's being assumed.
Oh, okay.
Did I say paid off?
Yeah.
No, it's assumed, it's being
I
assumed.
thought I misunderstood you. That's why I
No,
actually.
the loan is being assumed,
Right.
but the obligation is being discharged from the seller. That's why he's being charged for this.
And that's why you're doing the due diligence as to seeing the balance and the current
Well,
state.
that's why you get an estoppel letter. So you do two things. You get an estoppel letter from a bank, and then you pull out your notes from your modeling class and you do an amortization schedule and validate that what the estoppel letter says is in fact what the outstanding balance is on. And those of you, there's a few of you in the class who did this case study. In real life, there was a difference between what the Excel tools gave us as the outstanding balance and what the estoppel told us.
And what do you do with this?
Well, at the end of the day, you go with what the estoppel says, because that's what the bank says is owed. So, it doesn't matter. It doesn't matter. Because if the bank says I owe less, right, I just have to put more cash in. The purchase price doesn't change. So the component, whether it comes from equity or debt, is what changes. But as long as the discharge to the seller is the same as the assumption, it shouldn't really matter. I mean, and there's a series of other expenses that get paid. Title, surveyors, attorneys, right? Copies, whatever. And those guys all get paid. Those guys all get paid. What is important is at the end of a settlement statement is that your credits and your charges on each side of the equation equal. Now, they don't have to equal one another. The buyer's charges and credits don't have to equal the seller's. But the seller's credits have to equal his charges. And ultimately what you lead to is how much more money do I need to close? And how much money does the seller get out at closing? That's what really, all this whole exercise ultimately talks to, okay, I'm going to get title. I'm assuming a $20 million loan. I got to pay a bunch of miscellaneous expenses. How much cash do I got to come up with? And the seller's saying, okay, I'm getting relieved of a loan, I'm paying a bunch of expenses, how much money do I get out? Okay? That's what this ultimately talks to, okay? But you do have the obligation to do this, okay? It's the one moment when all the cash comes in and goes out, and it's the one document which allows you not only to do the accounting, but to understand and trace the flow of funds related to a transaction. So all this process leads to this. Reduced on a piece of paper, okay? You bought a 40-some-odd million dollar building, you basically paid $20 million and assumed the $20 million loan. That's the bulk of this particular transaction, and then there's a whole bunch of prorations and expenses for the buyer and the seller that need to be paid. Okay? Any questions on that? I'm not going to go over title insurance. I think we do that in another class. You do that, and I think some of your legal classes, you guys go over title. Those of you who've been in the program for a while, so I'm not going to do that. And I'm not going to go into any more detail on the specifics of all these items. So, but you've got a flavor, or you've got a sense for. The only other thing I want to show you related to diligence is I want to. And I think it'll pull all the concepts together. I want to pull up an investment package that I put together for a building that I did not wind up buying. I tried to get some investors to do this. They wound up not, deciding not to move forward. But it pulls together. It's a real-life building I mentioned the other day. It's in Gateway, which is a sub-market in St. Pete. And you'll see how all the stuff that we talked about last week gets rolled into an investment, book, and why it matters that we do this, okay? So, Wow, somebody did data tables and stuff, imagine, it might actually, it's not just for a class, so, anyway, this was a building that came, I think I mentioned, this was a building that had some parking issues. And I mentioned why parking was important. There's a compliance with municipal regulations, but there's also what tenant obligations that we assume and do we have. And then the third one is, how do we compare versus the market, okay? Because all three of those are important components with parking. So this was the building, it was called Echelon Point, it was in the Gateway submarket. I always try to put everything in one page, okay? So index, okay? So every document should have an index, right? I'm gonna pop this open a little bit and just say, I always try to summarize everything that I did in one page. Yes, Cole?
When would the parking, like, when would you get to that in the due diligence process?
So it could be in a couple of different places, right? So it could definitely be while you're doing your physical review when you hire a consultant to come in and take a look at the physical structure. They're gonna look at parking, okay? So they may look at it more from, does it need to be repaved? Does it need to be restriped? Is the drainage bad, okay? It may come in when you do your legal review. You may ask your attorney to take a look at compliance with municipal regulations. It could come in when you talk to your property manager, the incumbent property manager. What does he tell you vis-a-vis what your tenants are telling you, right? It may come in from your estoppel letters, which a tenant is saying, hey, you're not in compliance. Okay, I was promised 40 parking spaces, but I always have 10 guys I got to park across the street. The last place that it comes in is when you do your market analysis and you compare your building versus all the other competing assets. And you realize that you only have 3 per thousand and everybody else in the submarket has 5 per thousand. And now you realize you're at a competitive disadvantage. So that's where parking would come in. Okay? So I always try. This was the same sheet. I did $600 million of acquisitions in a 1031. Was the last thing I did at Florida East Coast. This is the same format sheet I would use to send up, and this would make its way up to New York. We'd have our local investment committee, and then the corporate owners would take a look at it. But I wanted in one page to have everything that was relevant. Okay, so everything that we did over a 5-week period, I could look at one sheet. And hopefully everybody had all the salient facts. Now they could ask other questions, okay? But what are we buying? We're buying Echelon Point, 123,000 square feet. It's a 5-story Class A office building, okay? I already know right there, it's 20,000, 21,000 square foot floor plates, okay? So I've already got it's a suburban office building, okay? The suggested sales price, now, why suggested? The brokers are leading us to that. So they're saying, look, this is what the seller's expectations are. If you looked at the videos this week, I told you there's always a very tight band. So, we could do our WAC, we could look at competing properties. You're going to see that we ultimately can validate this number by what I said, looking at RRs and taking a look at cap rates, okay? So, $186 a square foot or a going-in cap rate of 8.1. Now you're going to ask, isn't that high compared to today? I think what we talked about the other day, suburban office buildings in Florida are probably at 7.5% today. This is 2011, okay? And in 2011, where was the 10-year Treasury? Probably closer to 4%. Where's the 10-year Treasury today? You should know this, Isabel. Where is it?
Andrew knows it.
1.8.
I don't know.
You don't know. You should know. You may need to know this. 1.83?
It's
1.8, you're sure? You sure it's not 1.833 on the Wall Street Journal this morning? Isabel, you happen to have a Wall Street Journal this morning. On the very top ribbon, what does it tell you that it is? Let me have it. You're using your phone?
yeah.
You're using your phone in class? You don't trust your instructor when he tells you it's 1.833?
Just a very fast.
Great answer.
1.833. Okay, 1.833. Occupancy. So remember, all these things are ultimately going to talk to cash flow. Occupancy, 99%. Now, I'm gonna show you something in a second. In investment sales, there's always an assumed vacancy, which may be higher or lower than what the actual in place is. Okay? I'm selling a building. It's 80% occupied. Do I think that I'm going to get maximum value for that?
No.
Probably not. So I'm going to try to tell the seller, the buyers, hey, when it's stabilized, this is going to be at 95%. I'm trying to juice it up, okay? And the market, to some extent, might actually pay for that. You typically want to pay for in-place cash flow, but it's a competitive market, so you may have to assume that. Conversely here, when we sell the building, I wanted to assume a lower cash, I wanted to assume a lower, hold on, it doesn't recognize me without glasses. Believe it or not. All right. Okay, so I just, it's an easy technique. You lower, you increase the vacancy if you're that high, just to get a little bit of breathing room and not, be unrealistic in your assumptions. NOI yield. So now it's 2011. The question is going to be, what am I growing this to? If you looked at the video, if you got through all the video this week, you see that at the bottom of projections, we start putting a bunch of other metrics that we may want to look at times. So the question is, I'm buying it at 8.13. Where am I in 3 years? Where am I in 4 years? Where am I in 5 years? Okay? So you're at a 9. And this was something that our owners really were very keen on. And that's why I started including that, because these guys are looking at 3 to 4 year hold periods, which I don't think is realistic, but it's what they wanted to see. Okay? IRRs. We explained in the videos this week the difference between levered and unlevered. So now you start taking a look at, okay, somebody starts looking at, and I'm looking at an exit cap of 8.5. Look at all the information that you're getting right here, okay? What are in-place rents versus the market? Okay, so I look at this, it says, I'm at 24.50 and the market's between 21 and 24. Do we have an opportunity here to mark up?
No.
Probably not. If the markets were 21, in place 21, and the market was 24, maybe. In fact, there might be some risk at expiration that rents may go down. Okay? A fact to know. All right, so with a lot of occupancy come that, and this market spread comes a little bit of risk, okay? Who are my major tenants? I typically would list 5 or 6. You'd be surprised. It's the 80-20 rule, right? 20% of your customers are 80% of your revenue in a lot of businesses, okay? In this particular case, basically 4 tenants were the building, okay? And then rollover. I'm going to show you a chart. What's rollover? What's rollover?
The change in the tenants.
Okay, but
How many stay? How many release?
we talk on a year-to-year basis, what percentage of the cash flow expires and I need to replace.
Gotcha.
And that talks to risk. Okay, so what percentage of my income stream expires, which may be an opportunity to mark up or a risk to mark down, but definitely it's releasing risk. Okay, so rollover talks to risk. So when I look at this thing here, 3% in 2012, 0 in 2013, 2% in 2014, 2015, 5%. So it's not till 2017 that I got some rollover risk. Okay? So when I look at this building, 99% leased, okay? All the leases in place, credit tenants, I'm buying a bond here. Okay? There's not a lot of upside here. There's a lot of income here. One of the techniques we went through this week was taking a look at what composition of your IRR comes from capital appreciation and how much of it comes from current income. And you say, does that matter? I did a calculation on one of my investments yesterday for that. It does matter. Okay? I'm in a deal that will wind up with about a 10% IRR. Is it great? No. And probably 95% of it is current income. Just paying me my pref every quarter. And you know what? I'm an old man. That's what I need. I don't need the big speculative gain. Okay? So this is like a bond. I could buy paychecks corporate debt. I could buy Smith and Nephew corporate debt, right? I could buy corporate debt and get a 3 or 4% return on the bond. Or I could buy the building that they lease, right? Lever it and wind up with a 13.6% return. What would you take?
13.
It's the same credit risk. It's the same credit risk, okay? So, but this is a building that's attractive for a particular investor. It may not be attractive for another investor. This is an investor that wants his IRR to be significant, wants low credit risk, and wants a lot of current income, okay? Now, what else we talk about? I'm going to show you, when I wrote this, I hadn't been to the building yet, so I left a site visit, okay? Parking ratio, Class A, what market it's in, how big is the market? I'm going to show you the detail. How big is the market? How much product's available? So what's my competitive set look like, okay? What do incentives look like in the market today? How much rent abatement is there? What kind of TI is there? Okay? How much product is coming online? Okay? I talk about credit. Okay? I talk about debt and the possibility of debt. Okay? And I talk about what the seller's expectations are. Finally, in this particular building, there was a tenant that had the capacity, they had an option to terminate the lease early in exchange for payment. So, in exchange for $1 million payment, they could pull the plug. So, just something to know. There's risk because they occupy, whatever, 40% of the building. So, if they leave, I only get $1 million. And I lose the rest of their stream. 1 second, Kenny. Yes, Chase.
So I know this said it's a summary, and I know there's more pages, but this one page would be considered the abstract for that project?
Well, it's not an abstract. This was just an executive summary of my investment memorandum, okay? So the balance of the memorandum follows.
Is that similar information to what would be represented in an abstract?
No, an abstract, a lease abstract is a document. A lease abstract is a document that one prepares from a lease. And that lease abstract talks about, again, space occupied, the terms of the lease, the rates, the reimbursement structure, the increases permitted, expansions, early terminations. So it basically summarizes the conditions of the lease term, of the lease contract. Okay, that's what a lease abstract is. Okay, Kenny, you had a question.
Yeah, with the possible vacancy.
Yeah.
How would you analyze that? Like a call option?
Well, is it a call option? It's an option. And what they have is an option to essentially forego a payment stream in exchange for $1 million. How do you analyze it? You need to take 2 Argus runs and say, okay, if these guys stay in place, this is what I have. If these people blow out, this income stream goes, I get $1 million, and I got to figure out what's my probability of releasing, what's the market rents look like, what kind of capital expenditures do I need to incur in order to fill that space. What are my leasing commissions going to be? How much more TI do I need to spend? So it just becomes, it's sensitivity analysis, but it's detailed enough that you got to do 2 Argus runs. And then you just got to go with your gut and say, okay, if they blow out, what's the risk related to this IRR? Okay? One of the guys that I invested, people I invest with, the guys I used to work with, they always do 3 scenarios in their underwriting packages, right? So, to your point, Chase, they have an executive summary. Theirs is usually 2 to 3 pages. They spend a tremendous amount of time talking about the market. If you talk about the market, because that's where the income. That's like, there's no income, there's no building. There's no rent, there's no building. And so the market is the most important thing, I think. I mean, yeah, obviously building conditions and all that are important, right? And understanding lease, but you got to understand the market, okay? But those guys always do 3 scenarios. They do a base case, they do a best case, and they do a worst case. And that worst case assumes things like, in a scenario where somebody's got an early termination, that somebody blows out. Or they're looking at a tenant that maybe doesn't have the best credit rating, assuming they're going to terminate. They've been as aggressive in certain cases as saying, you know, we're going to try to seek this guy, we're going to try to seek a buyout from this guy, we're going to try to put him in a smaller place, you know, or just get him out of here and relieve him, okay? So it's always healthy to take a look at different scenarios and not just what you think is going to happen or what if you get lucky. So Pablo, you had a question?
Yeah, so that $1 million would be considered a termination fee?
That's exactly what it is. Because remember, we'll talk about bankruptcies in a second, right? But leases are contracts, and they're not really breakable, right? Unless you've got a specific provision that allows you to break it. So what's a lease? Those who took the account, what's a lease?
An agreement to use the space for
A
a
right
period
to
of time.
use an asset, in the case of real estate, space for a
Certain period of time.
right. So during that period of time, you're bound by the obligations that you know, the landlord is committed to give you that space and you're committed to make the payments. And it doesn't say whether you're occupying it or not or whether you can pay it or not. So this particular tenant, I don't know what their issue was. They weren't going to be here in Florida. They thought maybe they'd buy their own building. Maybe they weren't sure they were going to downsize. I don't know, whatever the issue is. And that's what they negotiated up front. You don't typically see early terminations like that, okay? Because a landlord is always, somebody's already coming in out of the box saying, hey, I want an early termination. What are you thinking? These guys aren't here for the long run.
Right.
You know, that's already not a good sign. Who had a question? No? Okay, so I'm not telling you, this is just the way I did it. So I went through the fluff, okay? So all this stuff, I'm not going to show you so this all starts with a broker puts together this beautiful, you know, color brochure, and they show you all the different, you know, they'll tell you all the reasons why you should buy it. And they don't show you any of the fleas. And then it's your job to find, you know, comb it and pull the fleas out, okay? So, you know, I just put some of the stuff, I started showing some of these in the offering memorandum the other day. So this is where the building is, and you know, where is it located? So in this particular case, this is West Shore, just where the Tampa International Airport is the single largest submarket, office submarket in Florida. In fact, it's much larger than their CBD over here. And so there's a small little submarket in Pinellas County called Gateway. And so what they sort of said is, look, we're only another 5-7 minutes across the causeway. We're a much nicer alternative for tenants. So that's how that market sort of, broad market, submarket, competing properties. And I spoke about that in the video this week, okay? So, you know, you can look at the, you know, densities and all that kind of stuff. Site plan, some interior pictures. I mean, this is all fluff. There's nothing of any value in this to now, okay? I showed you this the other day. This is a stacking plan. Now, you can do this yourself, but it's a way to try to graphically lay the tenants with the lease terms and conditions in the building. So you can look at it and say, okay, Paychex has the top 2 floors. Smith and Nephew has, you know, these 3. Regis and Quark are here, and then we've got a couple other little guys down here on the bottom, okay? And so it's just a graphical way. You typically see a stacking plan in most books that people, you know, put together. In this particular case that I showed you, it was even color-coded as to when the years of expiration of the leases. So you can look at one thing and get a sense of what the income stream looks like there, okay? Typical floor plate, so 25,000 square feet. Okay. So when we look at the market, I looked at the market. So this was all CoStar data. We used to have access to CoStar here in the program. Does anybody know what happened to that? So we had CoStar access. So they gave us, this is all subscription based, and it's based on what you use. So we got like a 10 or 15,000. You remember this? It's like we had like a $15,000 credit, and one student decided that they wanted to do some research for their own. And and in one day blew through the $15,000 credit, so we never got it again.
Are you serious?
Yeah, I'm serious. I'm serious. So, and exactly, maybe it was 2 days, but it was
At
gone
least
as
he took
quickly.
advantage.
It was quick. It was gone as quickly as we got it. Okay, so the way I look at this thing,
Talking Georgie.
This might be off the scope, but does this have anything to do with being an accredited investor?
Which is actually going to do.
Sam, directly, the answer to that question is no. I mean, you can buy real estate, you can buy and sell real estate without, there's no, it's not like a public transaction. Now, what happens is, funds or partnerships or LLCs that get structured or put together for the purpose of owning real estate, then you're subject to securities regulation as far as you're soliciting investors for making investments in that entity. So then you need to be an accredited investor, but not to buy the building. Okay, how do I start? Top level. Class A statistics in Tampa. How big is the office market, right? 211 buildings, 30 million square feet. How big is the total market? 142 million square feet. Why do I care about Class B and Class C? Well, Class C assets are never going to compete with a Class A product. But some Class B might, okay? So I want to understand what the totality of the market looks like, okay? I want to understand that Class A is at 22 bucks across the entire market, across the entire metro, at 18 bucks a square foot in Class B, and it goes down to 15 bucks in Class C, okay? Blended 19 bucks a square foot. But and I start getting an idea of where my building is in comparison to the whole market. Now I start coming in a little bit more. Okay? So what I want to see is I want to take a look at the submarkets. Okay? Pinellas County, Class A. Now I don't care about Class B or C anymore. I want competing product. There's 68 buildings in Pinellas County. It's 7 million square feet. I'm 123,000. I'm not a big player, okay? Market rents are 20 bucks. I'm above the market. I'm above the market. I need to know that. Need to understand that. We already had that summary there. Market rents are 21 to 24 bucks. I'm at 24.50. Okay? I'm on a high end. Okay? But out of the 31 million square feet, only 8 million are in Gateway. It's not a big competitive set. And I start looking at things like, and I'll blow in a little bit more into that. How many square feet are available? Okay. What's the vacancy rate in that market? Okay. And what's the absorption? And then I'll look at how much product is coming online. And somebody asked me the other day, how do you pull all that together? I'm going to show you that in a second. So I looked at the total Class A market. Okay. I'm looking now at all of the sub-markets. Okay. So Pinellas was 68 buildings, Gateway is only 24, okay? And then I'm going to go even further than that, okay? Because what I really want to know, and I'm just going to jump to the next page, is I want to know those 24 competitive properties that I compete against in Gateway, what do they look like? Cole, what's the parking ratio of all the competing properties, okay? How much space is available? It's 292,000 square feet that are available. There's a whole building out there that's available. It's asking 21 bucks a square foot. So, if I lose a tenant, these guys are ahead of me. Okay, I don't know what's going on there, because later on that building, I don't remember now, that building was not just newly delivered, okay? But when I take a look at 3 million square feet of Class A product in my submarket, there's 292,000 square feet that are available, right? And there's people asking, okay? People are asking anyone from 21 bucks? I'm the highest guy in the market. That's okay, but I need to know that.
Why is that okay for you? Like, I know you like.
Because I'm 99% leased, because I got the nicest building. I mean, you know, I mean, I'd rather sell a Porsche than a Volkswagen. Why? I don't know. I just would. Some people would rather sell Volkswagens, you know? There's nothing wrong with them. They're owned by the same people at the end of the day, okay?
And that's because
Same company.
your long-term
Yeah.
leases make that attractive.
I'm sorry?
Your long-term leases, in your opinion, make that attractive?
Well, so depending what you want, right? So if what I'm looking for, and that's what I said, this is a building that's attractive for a particular type of investor who doesn't want a lot of risk, okay? So the income's assured, 99% of the building is leased, it's credit tenants, and there's long-term leases in place. And I can put long-term debt on it. So now I can feel pretty comfortable that I can get my 13%, you know, IRR, assuming the capital markets, assuming I can sell it at some point, okay? But for the foreseeable future, I'm going to be able to pull out, you know, probably 10, 11% cash on cash. So if that's what I'm looking for, that's good. That may not be the investor I want, or the investor that that's looking for a building. There may be an investor that wants a building that's empty. There may be an investor that wants this building that's only 27% leased, okay? Because he's asking 21, and he thinks his building is as nice as mine, and he may not get to 25, but he might be able to, do leases at 23, okay?
And lease it up.
Lease it up and sell it to some other sucker. Okay? So, but that's, hey, look, no, but here's the argument. It's like, okay, it's a little older, but it's not that much older. I got a better parking ratio than this guy, okay? I got a lot of availability, and you know what? He really can't lease any space anyway, okay? Because he's essentially fully leased at this point. So, you know what? The next leases in the market are coming to me. Everybody else is pretty much, there's only a couple other buildings that have any kind of, space available, okay? So, I'm not saying there's a right or wrong answer, it's just understanding what you're walking into. I can tell you though, this building presents a nice case for an investor that's looking for income. Yes, Kenny, you had a question.
Well, no, since you started presenting this project, I always wondered why you never just took that as a value add and just built a parking lot. But
And built a what?
a parking lot,
Well, so,
Probably wouldn't raise the value.
first of all,
Well, no, the developer hat came on, but now I understand it's because of the investor class you were seeking.
well, the first thing is you've got to make sure that you can get additional land if that's the case, and that would be satisfactory, okay? It's a little bit more complicated. I was working with some guys, I was coaching some guy's kid who has become a friend over the years, and they had a private equity group, and they had investors that were looking for real estate exposure. And this was a pilot for what was supposed to be a $200 million fund. And the guys never bought into the fund idea, and so, I don't have the wherewithal to put, this is what was it, $28 million building or whatever, $30 million building. I don't have $8 million to put into a building. And if I did, I probably wouldn't put that kind of money into one building. So I couldn't do it, right? And in 2011, it probably was difficult to find a friends and family group to put that together. That might be easier today, right? But coming out of the financial crisis in 2011, you weren't doing a friends and family deal for a building like this. It just wasn't attractive enough, from a risk-return perspective. I think today people would jump over this in retrospect, but not at the time, so.
Yeah, 2011 would be like opportunistic almost. You want to buy.
And then the return profile isn't good enough for an opportunity investor.
Yeah, exactly.
So, and that's why it was available. I thought it was, listen, this was an investment, this was a Guatemalan national who was looking for current income. Yes, Jonathan?
Is there a correlation between the Gordon growth model and the weighted average cost of capital?
Between what?
The Gordon growth model and the weighted average cost of capital? Or, because this is the net present value on this is based on the stable.
Hold on, dude, you're throwing too many thoughts at you. Hold on, I gotta process. Hold on. I haven't got, is there a correlation? Okay, now, correlation, so that's not the right, is there a relationship?
A relationship.
Okay, well, To the extent that the Gordon growth model might be a proxy for calculating the cost of equity, of course there's a relationship between the growth model and weighted average cost of capital. Now what's the follow-on thought?
Okay, no, that's where, yeah, so if you calculate, so the net present value is based on the stabilized NOI of the high credit planners, quality credit plans. Listen, that's how you got your 13%.
Yeah, but yeah, I want to get to the model in a second, okay? I'm going to get to the model in a second. Okay, so this is what the competing assets look like. See, Cole, to your point, here's the building with all the vacancy. That looks fine. I mean, I might want to buy that. Now, maybe it's not on the market, you know? But maybe that building might be more attractive than, okay, so the question somebody asked, I think it was you, Cole, the other day. I don't know, maybe it wasn't you, but the question was, so, not that small. Okay, so the question is how do you overlay all of these market facts together? This is how I do it, okay? I'm not the only one who does this, but I try to intersect vacancy and rental rates, and then I try to take a look at absorption, okay? And I try to put it all in the same page. In fact, I used to put it all in the same chart, but then it was busy for a lot of people. So let's just take a look at the two pieces. So 2006, 2011. So this is a 5-year view. Red is vacancy. Blue, okay, is rents. So rents are going up, 21, 26, 27. Rents are going up. Vacancies are coming down. So as this widens, what's that telling me? That's good. But then I got to be careful, because then I got to take a look at what's happening here, and that's how much absorption there is, okay, and how much new product is coming online. Okay, so absorption, a lot of people are demanding, All of a sudden, 171,000 square feet come online, additional supply. What happened to vacancy?
That had no correlation to the year.
Hold on. Vacancy went up. What happened to rates?
Down.
Okay, so what was your question?
That had no correlation to the year? Because you said 2006, so I'm assuming that's 2008?
This is 2008, this is 2009. Yeah, but the world didn't stop. I mean, so there's an economy, people didn't just like, I mean, so a lot of people lost jobs, a lot of investment was lost, but like buildings just didn't like shut down. I mean, Smith and Nephew, they make like knee replacements and stuff. They still kept selling knee replacements. Paychecks processes payroll for people. They kept processing fewer people. They made less money, but the world didn't come to an end. But all of a sudden you see the supply comes up, and I will tell you here, now in 2009, now you've got negative absorption. Now you got all the carry-on effect, because at first people are in denial. This is going to blow over, this is going to blow over, this is going to blow over. We better start firing people because it's not blowing over. Okay, we got to stop capex because this isn't blowing over. Okay, and so it takes time, and then you see, you know, vacancy starts coming down a little bit, but it takes a while for rents to work their way back up. A lot of times, what takes years. I remember. In industrial in Dade County, what it took us to build rents up from 2000. So it was a big telecom crisis in 2000, 2001, the internet bubble. Some of you might not remember that, but there was a big blow up in the economy. So rates were way down. It took us from what took us to get from 2000 to 2005, 2006. We lost all those gains in like 3 months, you know. Rents went from like $3 to like $9 and then back down to $4, like that. Okay, so it takes a while to get rents coming up. Yes, Cole?
What was the effect from the dot-com bubble on real estate? Was there a big...
So yesterday I drove in front of a property I used to run. I think I mentioned the other day I was talking about this whole Delta call center that we were gonna... So my old boss, not the guy that owned the company, the guy that was the president of the company, he's the guy that wanted to develop this Delta thing and all that. So he's working at Foundry now, okay, that place that I mentioned the other day. And he always, I mean, he's like one of these guys, it doesn't matter what the deal pencils out to, okay? He just wants to build it. That, we all have different DNA. You know, some people just want to do the deal. We have people like that in this country. They don't care what the outcome is, they just want to do a deal. So he's bought where that Delta thing was, and he's put a 400,000 square foot industrial building that's just totally empty. It's beautiful, but it's totally empty. I mean, I just saw it. But what happened? We bought that to originally become co-location space. So we paid $47 million for that asset. By 2002, if we would have sold it, we would have gotten maybe 20 million for it. Now we eventually sold it for like 52. We eventually stabilized it. We, you know, were able to rebrand it, you know, the trade zone again in a high secure environment, and we got the occupancy back up to about 85%, and we were able to sell it. But there were a tremendous number of, there was a tremendous investment. So that's what happens in real estate. People pile into stuff. So, I mean, in Dade County, people were paying double what real estate was worth because there was a presumption that telecommunication companies would pay double and triple what other users would pay because of the location. I mean, I was brought on after they bought the deal, and I kept asking, it was before we closed, I kept asking, I didn't know about real estate. I kept asking, well, what makes you think people would pay more? Oh, no, they will, because they all do. Well, because there was easy money. There was easy money. There was the WeWorks. It was the WeWorks. It was the Compasses, right? It was all, you know, where there's easy money, people spend it and find justifications for that. So the, you know, to answer your question, yeah, there's a tremendous amount of money that was lost because people speculated in you know, the value of real estate because of perceived location.
Well, I mean, like, did like the asset values, like, so in over
Well, yeah, so well, but see, there was a whole collateral economic, not only were things happening within real estate, there were a lot of things happening in just the internet in general. There was a lot of speculation going in, and there was a lot of credit going, especially into telecommunications companies. So it was a tremendous impact to banking, to financial institutions. So credit dried up overnight because banks wouldn't lend. Okay. People lost their jobs, and all these internet companies, tenants blew up and disappeared. So I mean, it was a whole sort of, you know, it was a whole, you know, look at. I'm not going to do it now, but if you look at, you know, the stock market from 2000, and then just look at economic activity, there was like a 2-year, you know, doldrums there from 2000 to about 2002. So and then I don't want to say housing got us out of this, but there was a whole bunch of government initiatives to push housing, including easy credit, and that led this whole construction boom that kind of got us out of there, but then led us into another, you know, mess. So
it doesn't really, like, the pop of any bubble will ultimately affect real estate drastically. So like whether
yeah, because real estate's a business. It's kind of ubiquitous across all businesses because they have to operate somewhere. So some might be more insulated than others. I mean, I always use the example. If you look at Simon, all through 2008, 2009, 2010. They were increasing rents.
Really?
Take a look.
I mean, I believe you. I'm like, how did that work out for them?
They have high-class malls.
How did it work out? I mean, the
Like
stock was
people
like
were
at
willing
$80.
to pay higher premiums for retail
Where are they going to
space?
go? Where are they going to go?
It's a
If you're
different
Gap,
level.
where do you go?
Yeah.
And this is what I was talking to the other day. Retail leases. Some of what characterizes real retail leases is that they have a very long. They have long terms and they have multiple renewal periods. And so stuff that was renewing that was maybe 30 years in the pipeline, where are you going to go? If you're Gap and you're at Aventura, where do you go? Across the street? You know, so I'm not advocating for Simon or for retail malls, but I'm just saying, okay, so, hold on, come up. Yellow. I see you. Okay, so do you see how that works? You guys see how that works? You see how you can pull it all together? And then, you know, the comment that I also make is nothing under construction and nothing planned, okay? Because you not only want to look at what's been delivered, but you want to see the pipeline and see what's coming out there, okay? So when I looked at this, I also saw, okay, I'm starting to get some stability here in both rents and in vacancy, and hopefully I can start seeing that go up, this go down, and the absorption come up, okay? And I know that if nothing's planned and there's nothing under construction, I've got 2 or 3 years that I don't have to worry about, because it's going to take 2 to 3 years for people to deliver a competitive product, okay? So you know, you look at large transactions. If you can get pricing information, you do. If you can't, at least you know who's in the market. Sales comp. So we talked about the sort of lease stream. These were 2 competitive properties that I found in general nearby markets. $85 million for both of them. $195. I think I was proposing $186 a square foot. So I'm not far off where the market is at that 8.13 going in cap rate. Okay. Similar type buildings. Okay. And then there was another one that I couldn't get. There were some. It's another one I couldn't get. Okay, but it was reported to have been $183 a square foot. I just couldn't get the closing on it. Okay, so we're all in a. So I mentioned a rent roll. So the rent roll is a legal document. Okay, and it's a summary of all the leases that are in place. Who's the tenant? What space do they occupy? What's the rate? What are the increases? Okay, how do they reimburse expenses? Okay, and any other comments that there might be, what TI I got to give them, what expansion rights they may have, what early termination rights they may have, etc. Okay, so very important. Ultimately, this validates the leases. This validates, or it's validated by the abstracts, and ultimately flows into your Argus model. Yes, Chase?
I don't know if it necessarily applies, but you just mentioned with like the tenant improvements. Can you just, I'm not entirely clear, what is a leasing commission? And like, that's like similar, or it counts as CapEx in a deal? Because I know tenant improvements are like the build outs that obviously, you know, whoever leases your property from you wants you to put in. There's one over by the computer.
Or isn't it just turnover? Isn't TI just turnover? Like once your tenant leaves, then you're fixing up the space they're in?
So let's talk about 2 different concepts. Let's talk about in the context of a cash flow statement. Okay. And let's talk about first in the context of a lease structure.
Common area maintenance.
Okay. So in the context of a lease structure, you typically, we said a lease is a right to occupy space. A real estate lease is a right to occupy space for a fixed period of time. Given market conditions, not only do you talk about the time and the rate that people are going to pay you, it's very common, because real estate people may not be the most intelligent people in the world, to provide incentives for tenants. So those incentives are going to be based on market conditions. Those incentives come in a variety of different ways. Okay. The first sort of line of incentive is, it's called an abatement period. Okay.
Can you? I can't see what you wrote.
Incentives.
No, on the top.
Lease structure.
And then on the
term.
Term.
Rate. Incentives. Abatement period. What's an abatement period?
3-month rent.
So it's a period of time in which you can occupy the space without paying rent. Why would a landlord agree to that, and why would a tenant ask for that?
Just improves the relationship, almost like a discount for bulk. Like if you were a wholesaler and you bought a lot of quantity, they give you a smaller.
To make you feel good. No, it's for cash flow. It's because you pay less.
Right.
So,
No, but
it's-
yeah.
I don't care if the tenant feels good, I just want him to pay.
I feel
eventually.
great paying less.
Okay, it's,
What do you mean for cash flow? So that you get them in there and they're willing to pay a little bit less?
well, no, let me give you a different scenario. So my mom last night went to, now I don't know the particulars of the lease structure, but my mom went to the opening of a new facility for a business that my dad used to run. And so they got a warehouse out in Beacon Lakes, and what I bet you they have is a 6-month rent abatement period. And you're gonna say, why do I bet that? Well, because there's a series of costs that a business is gonna incur when they move into a new place. There's gonna be some sort of business interruption. There might be some physical presence, maybe in retail. I mean, maybe in industrial it's not that big, but in retail it definitely is. Maybe even in office. There's gonna be some disruption to clientele, and possibly to your income stream. And there's gonna be costs. These particular people are putting a freezer in place. So there are certain expenditures that you make as a tenant to move somewhere. And so you need some breathing room. So the landlord says, okay, I'm gonna give you some rent-free period so that you can get your feet up from under you, you know, get yourself on steady footing. That's a hypothetical reason to do it. A pragmatic one to do is that's the only way you can keep the people. It's the only way you can get them in the door because other properties are offering free rent as well. And you're gonna say, well, why would a landlord do that? Well, there's a lot of different reasons why a landlord would do that. Because at the end of the day, a landlord wants to capture the tenant for a long period of time. So a typical trick would be to say, okay, I'll give you a 6-month abatement period, but I'm not gonna give you a 10-year lease. I'm gonna give you a 10-year and 6-month lease. So I still get a 10-year lease from you, okay? But you start paying me in 6 months, but I'm still getting 10 years. And more important than that is when I sell the building, I'm gonna sell the building based on what?
Physical occupancy.
The then in place NOI. So I don't care if I give up some income now, as long as when I sell the building later, that cash flow is in place. So if I can snag this guy as a tenant now, so 5 years from now, he's paying rent, and that rent is gonna be worth a big multiple, it's gonna be worth a 6 cap to me, I'll forego 3 months or 6 months of rent now, because you know what? I mean, the space is gonna be empty one way or another, so if I don't get them, it's empty. Okay, so the first, now, there's no cash cost to an abatement period, okay? There is no cash cost to an abatement period, but it's a concession. In multifamily, it's common, give somebody a month free rent. So you do like 13-month lease and you get a free month rent, or you do 12 months and you get a, so you're really collecting 11 for 12, okay? Now, that's one incentive. What's the next incentive that you get?
They build out.
Tenant improvements. Exactly, the build out, okay? So, you know, that's different for different asset classes. So, in office, today, I don't know, in South Florida, maybe somebody's gonna pay you 40 or 50 bucks a square foot to build out an office. So what does that mean? It means they're gonna accommodate, they're gonna prepare that space for you up to $50 a square foot. Maybe
Is that like paint, knocking down walls? Like what it would be included?
Well, so paint and carpet's probably like 10 bucks. Okay, so 50 bucks is more than paint and carpet. So
like what other, like chairs, like furniture, like all those
no,
things?
I'm not talking. Ooh, no. That's a different category. Okay, so and you typically don't want to go there. Okay, so you are going to do partitions. You're going to do ceiling. You're going to do lighting. Yeah, you're going to do carpet and paint. Okay.
Like extra walls and stuff. Yeah.
Framing, walls, drywall. Okay,
You wanna,
doors.
like, cut
Okay.
it in half.
So you know you're going to set up the space for an office. Okay. Retail works different. So in some retail centers, the landlord doesn't pay anything at all, and the tenant does all the fixturization, and they'll get a lower lease rate. Sometimes the landlord will pay, but usually the tenant actually does the fixturization and build out themselves, okay? In office, in industrial, you don't want the tenant doing the work. You give them an allowance, okay? And then you do the work as a landlord, all right? Now,
Why is that?
They might screw up your property.
Yeah, exactly.
well, you know, you want them to do it right, okay? You wanna make sure it's up to code. You wanna make sure that you've got all the as-built, the way you use your own architect, etc. Now, there may be some other incentives, so there's definitely a cash cost associated with that, right? In industrial, you typically will pay for the office build-out, which is usually no more than 10%, okay? Now, that's usually first generation space, and definitely in Class A. Now, you get to Class B office, a lot of times you're going to say, you know what, you got to take what's here, and I'm going to give you painted carpet. You get 10 bucks, okay? I'm not redoing partitions here. You got to, guess what? Congratulations, you got a promotion. You got a really big office now, okay? Okay? I'm not subdividing this, you know? Oh, guess what? You got an office and a conference room and a cafeteria all in one place, okay? You figure it out, okay? There might be some other cash incentives that you pay that are directly related to that. So you might pay for the space planner or an architect, okay?
Like service-based things, not product-based things?
Well, typically first line to support the build-out, okay? So the architect and the space planner may be part of the allowance, or might be an additional allowance that you give people, okay? Now, there may be additional incentives. You typically want to stop here, okay? You typically don't want to go any further than that, okay? And the market's going to dictate. I've seen abatement periods when the economy's really bad as long as a year and a half on industrial, believe it or not. I've seen as long as 3 months on multifamily, okay? I've seen six months to a year in office, okay? I've seen build-outs go up a little bit, not a lot. Now, a lot of times somebody comes in and says, oh, I want gold-plated plumbing, you know, some of you have done a case study with that in my classes. You know, I want $100 build-out. Well, sometimes you might do it, and you just charge them and build that into the lease, okay? Now,
Leasing commissions?
We're still talking about lease structure here. I haven't gotten to my cash flow yet, and expenses that are related to my cash flow, okay? So, as it relates to this, you may assume leases somewhere else. Okay, so you know, you're in 3 different locations. I'll assume these leases for you. You know, they're going to expire in 6 months, 9 months, or whatever. You assume those leases and then just consolidate the guy. So that's one thing you can do. You can pay for signage. Okay. All right.
Is that not a tenant improvement consideration?
Signage?
Yeah, like is that considered more of a marketing approach rather than like a necessity?
Yeah, I mean, because at the end of the day, when I talk about signage is, I used to work on a building in Chicago, 600,000 square foot building, and it is the stone container building. Okay, so it's not a little marquee in the door. This is a big ass sign, sorry, up top, okay? Okay, this is a big one. And now this is the stone container building. This is no longer, and this was a real deal where this is in the 1980s, not only did they do build out and have a big abatement period and pay for this, but they assumed a bunch of different buildings and brought the tenant from like 10 different buildings, and they provided big signage. Another thing that you could do is you can do FF&E, right? Going back to your question, Chase.
Fixtures.
You may provide furniture, fixtures, and equipment. Typically what you're going to want to do is something that might have a value at the end. Partitions, you know, like steel case partitions and stuff like that, okay? So
Furniture, what was the middle one?
FF&E. Furniture, you really need to take the accounting class. Furniture, fixtures, and equipment. Yes, sir.
But
or
the sign-
PP&E, plant, property, and equipment.
Oh God. With the signage, that's controlled. So you would do that. You would just do that as a credit.
You would do all of that stuff. You might do it to their specs. Okay. One of the deals I'm involved in is a retail center up in Tennessee. I'm right off I-75. We put up a big old marquee or whatever so that everybody could put their signage. We're doing all the work. But they're giving us their signs because it's very, you know, sort of brand oriented. But they had to do it to our standards, you know. Okay? But you control all that.
Okay.
All right? So that's what, so these are payments you might make related to a lease. As it relates to CapEx, what we call capital expenditures, I'm going to jump ahead, and so I don't need to cover it later. It's in the video anyway. We have revenues, we have expenses. Okay, you can call them whatever you want to call them, whatever makes you happy. Effective, potential, blah, 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 whatever you want to call it. Revenues, expenses, and they come out to NOI. Okay, that is not a distributable amount. That amount we use for cap rate calculations, but that's not a distributable amount. Because in almost every, okay, real estate asset, you have capital expenditures, which are, so I don't want to get into an accounting class, right? But there's a difference between ordinary, operating, right, maintenance items, and things that add value to an asset, or things that have multiple years worth of value. If I mow the lawn, it has no value for more than 2 weeks. If I spend $100,000 putting new buildings, new trees, those trees might last for 20 years. There's a case to say that those trees might have a depreciation base over some time, okay? And so it's not a cash. Remember, I'm looking for cash flow here. So there's no depreciation here, okay? There's no building improvements here. But that doesn't mean it doesn't impact cash. So we got to come up with CapEx. What are the typical CapEx items that we have?
The roof.
Okay, we're talking about lease structures first, man. I'm just trying to flow. I'm just trying, like the first thing that comes out is leasing commissions. Okay? Every time I sign a lease, I got to pay a broker something. Brokers don't work for free. How much are leasing commissions in this country?
Like 3%? 2%? 1 to 3%.
Ay, Dios mío. Okay, so it's going to determine, it's going to depend on term, and it's going to depend on whether you're a landlord rep or you're a tenant rep. And it's going to depend on the market. Let's say that, you know, depending on the asset class, there might be different breaks between the first 5 years and the first 10 years. Let's just say from year 1 to 5 there's going to be a structure, and from year on there's going to be another structure, and then there may or may not be some sort of commission at the time of releasing, okay? But if you are the tenant rep, in today's environment, you're probably going to get something like 4% or 3% for the subsequent period, okay? Now that's of the gross income stream, If you're the landlord rep, okay, you're probably going to get 2 to 3% and 2% here, okay? So total commission is going to be probably 6 to 7% for the first 5 years, and 5 to 6 thereafter. Okay, that's of the gross lease stream. When is that paid?
At closing?
There's no closing. Closings are for sales. This is for leases.
In terms of like the signage of the lease, like when the lease is finalized.
Isn't it when they enter?
When is the lease finalized?
I guess when the lease is over, but when they're, I don't know how to say. You know what I'm trying to say.
No, I don't. That's like words mean something.
When they move into the building?
Yeah, I guess.
and
So on
actually
occupancy, so you told me when lease signing, you told me occupancy.
Well, lease signing.
Lease signing.
It's moving the
occupancy.
Lease signing.
Or is it both?
half and half.
50% upon signing the lease, and 50% is on lease commencement. Okay, commencement may or may not be occupancy. May or may not be occupancy. Okay, in theory you want it to be occupancy, but it may not be occupancy. Okay?
So if TIs are taking forever, you still.
Well, it could be TI, and it could be the fact that the lease commences on so-and-so date. You're not ready to move in because you don't have your, whatever, put together. So, okay? And then, so leasing commissions is one. What's the next one? We just talked about coming up with a lease structure. Tenant improvements.
TI.
So those are, again, Leasing commissions I pay today, but there's a cash stream that's coming for the next 10 years. So I can capitalize that and amortize it over the lease term, but under all scenarios, it's not an operating expense. But I gotta account for the cash somewhere. So I don't account for it in my operating expenses because it's not an operating expense. But I gotta account for that cash somewhere, okay? What's the last sort of general?
Like building improvements?
Now you could say the roof. So building, recurring CapEx, okay?
Is big trees like palm trees and things like that in these big developments, is that landscaping or?
Hey, look, it depends. Like, look, there's a fine line between what is ordinary wear and tear and replacement for day to day and what has long-term value. You know, trees, trees are probably not CapEx, okay?
I mean, you can spend a lot on trees.
They could be, but you typically replace, this got yellow blighting and change one, okay? So, redo the roof every 10 years, okay? Paint the whole building every 7 years, okay? Put new elevator cars in every 10 years. That's CapEx, okay? You have a service contract with your elevator repair guy. That's operating expense, okay?
So if it's
Somebody kicked the door in and you gotta replace the lock on the door. Operating expense.
Okay.
You change all the doors in the building every 5 years, CapEx.
So
Okay?
it depends on if it's like cyclical or kind of like spontaneous.
If it has long-term, if it adds value, it has future benefits, and so you're trying to match expenses today with future cash flow. There's a, you gotta take the accounting class, matching concept. You wanna match your revenues with your expenditures, okay? Yes, Sam?
I know from previous environmental law classes I've taken that there are some rules about if you're making a property and you're taking away some nature, you have to replace it with nature. Like if you take away
Okay, so that's what we were talking about mitigation the other day.
Yeah.
So if you impact like wetlands, you've got to essentially replace them somewhere else.
Right.
Yeah.
But you then argue that those trees are also giving you value, and then at that end, that's kind of
But typically mitigation, we're talking about existing buildings right now. You're typically going to impact wetlands and things like that in a development process. So they're definitely part of a development cost, but they wouldn't be
okay.
here, okay? And then what else do we have after CapEx that we subtract from NOI?
Our debt service?
Debt service. And what's in debt service? What two components?
Yeah.
Interest and principal. Okay. Okay, who had a question on this?
How about insurance?
Insurance is an operating expense. I gave you a whole list of operating expenses, typical operating expenses, but that's every year. You pay your premium every year, right? You don't pay the premium, you don't get coverage, right? So it's an operating expense. Okay, any questions on that? Just a couple of other things to go over here. Okay, this is the rent roll that I talked about. So it basically is a graph of when leases expire. And you can see, graphically, you can see that 2017, 2018 are where you've got lease expirations. This is both a risk and an opportunity.
Is this for commercial or residential?
Residential leases tend to be 1 year or less in this country. So you wouldn't typically have a long-term rent roll. So this would typically be all other commercial real estate assets that are not multifamily. Okay? So if these two bars were here, the building probably would not be sellable. Why wouldn't it be sellable?
Because too much is expiring.
Okay, but what's the implication of that?
You have to
Higher
release
risk
it, there's
profile.
cash flow is going to stop
So
at the time of purchase.
can you capitalize a perpetuity here when there's no ongoing cash flow?
No.
No. So when you sell a building, This is the diligence you gotta do. When is a good time to sell a building? When you don't have big lease expirations for another 4 or 5 years, okay? Because now you can tell the guy, yeah, they're not going anywhere anyway, okay? So, you got, and then once you get past this hump, you probably can sell again, okay? But if you know, so if you buy it here, you probably can't sell till here. Yes, sir.
Are there some investors that particularly focus on buying things at expiration time with the idea of, you know, kind of negotiating a lower purchase price and the, saying I have to lease this building up? Like, is that a certain investment profile for a certain person?
I mean, I think there's people that have more risk tolerance than others, but I'm telling you, you rarely would see. You would only see somebody selling a building with that kind of expiration that's in distress.
Right.
So, you know, a stable seller would not sell at that point.
Gotcha.
Okay, so this is just a cash flow. This is a dump from Argus into Excel, and so this is an office building, but cleaning, repairs and maintenance, utilities, security, insurance, taxes, management fee. It sounds pretty much like, so, you know, maybe in an apartment building, you don't really have a lot of cleaning because you don't clean people, but in an office building, the landlord typically provides the cleaning. You may have security or you may not. An office building may have a guard, you know, there all the time. So you might have a couple of different, but the concepts of operating expenses don't really change from asset to asset, okay? Income, expenses, NOI, leasing commissions, cash flow before debt service. Does that look like something I just did over there? Revenue, less expenses, less capital expenditures, less debt service. Yeah, that's what we need to know. Okay? Now, what do you do with this thing? Now we got overlay leverage on it now, right? So, okay, well there's a couple of things before we go there. Those of you who've done Argus already might, so this is just a target sheet that I used to use, that we used to use where I worked, which targets the inputs in Argus, okay, that you're going to need to put in. So market rent today and at the time of releasing, okay. In this particular case, office or small office, it could be big bay industrial, small bay industrial, you know, maybe it's just office, okay? How much is the rent for new space? How much is it renewal, okay? When the lease expires, how many months is the space going to be vacant? What's the probability, right, that you're going to renew? All right, so here, renewal probability, 75%. So the way the way Argus is going to work is, if I'm assuming that 75% of my lease is going to renew, the way the cash model works in Argus, the model works in Argus is, it's going to take at least 75% of the lease that expires, and it's going to lease the other 25% vacant for 6 months, or for 2 months in this particular case, because it's 75 or 25%, okay? How much TI do I need to spend for new space, for renewal space? How much are the leasing commissions, okay? Any rent abatements that I'm going to incur? But you need to have the inputs already summarized and agreed to, and understand what the market is giving in order to do your models, okay? Any questions on that? Okay, these are just a summary of the operating expenses, and you can validate that. We've talked about that. Tax returns, previous operating reports, conversations with management, review of in-place service agreements, review of your knowledge. And you can, if you go to markets that you don't know, you can go to like BOMA, the Building Owner Managers Association, and get benchmarks for what competing properties pay for operating expenses in those markets, okay? So, so here, as you can see, we don't quote on a percentage basis, we go on a per square foot basis. Suburban office building, 2011, $11 a square foot, it's probably about $12 today. Okay. BOMA, B-O-M-A, Building Owner Managers Association. It's a big trade group of property managers and asset managers. Okay, and then,
Just a sec.
Hmm.
Sorry. Siri.
I wonder why Siri would call you.
No, just when you press the button. Just the-
Oh, I see. You're pressing a button, are you? Okay, so we don't need to look at the numbers, but we can look at the concepts, and we'll look at it a little bit. So, an unlevered and a levered scenario, if you got through the videos this week, you would have seen something similar to that, okay? You see the cash flow before debt service. You see a reversion. So you see year 11, you see year 11 cash flow, you see a cap rate, you see a value, you see selling costs, okay? You can shoot it at the video too, because the video's got all this, okay? All right? So, and then the cash flow, purchase price plus closing cost. Miraculously, if you saw the video, closing cost 0.5%, cost to dispose 1.5%. I mean, these aren't just numbers that come out of the vacuum, they're real life numbers, okay? Unlevered IRR, 9.6%. Levered, you overlay leverage on it, 13.6. So you just gotta, you put less cash in. You saw it in the video this week. We'll go through it again. Less cash in, but now you gotta service debt every year, okay? 13.66. And how do you finalize that? You finalize that by doing some sensitivity analysis, okay? And I just did some, different, playing around with cap rates, which as a consequence are gonna, going in are gonna give me different purchase prices. How's that gonna impact my IRR, levered, unlevered, and what the implication of that is on a per square foot basis, okay? And then I just played around with some other things, what's the rate of, what's the impact depending upon different interest rates and the different leverage components. And you can see leverage really can juice up returns, okay? More so than changes in interest rates. Notice that changes in interest rate don't really impact you that much. But how much leverage you use on a deal definitely can, again, as long as your cost of debt is lower than your project return, the more leverage you can pile on, the better you're gonna be. And then just, different exit caps, right? So one of the things that I warned in the video was using exit caps that were below your going in cap rate, because you're kind of creating artificial gains, okay? You can see all of a sudden, if you drop the exit cap, it gives you a huge return. Conversely, the risk obviously is if cap rates change on you, invert, they go up, you could definitely, be hurt pretty badly. Okay, so that's it. That's a presentation, and that's a summary of a diligence project on a particular building. Okay, any questions? No questions on, any question on diligence, because I'm going to move on at this point. We're good? Okay. The reading this week was chapter 13 and the supplemental 2. I'm going to send you my notes. I've put a lot more notes than what are in the book. I thankfully don't know a lot about bankruptcy. I know a little bit, but not a lot. I'm going to just supplement a little bit of what the book has, and then you can go through the notes. The book had really very little in the context of securitized debt, of commercial mortgage-backed securities, and I am going to spend a little bit more time on that because I think that's important. That's a critical source of financing in the commercial real estate industry. It does ebb and flow, but you've probably got, I don't know, let's say $1.2, $1.3 trillion worth of commercial mortgage-backed securities out there today, which is probably 30–40% of the debt stack in commercial real estate. So you need to understand it. You need to at least know what it is. The book focused the context of bankruptcy more in the way of distressed debt, okay? Brian, distressed debt. And, you know, talked about, you know, borrower delinquencies and what happens when you've got distressed debt. You know, do you restructure? Do you give the asset back? Is it foreclosure? What do you do, right? Do you file for bankruptcy? You know, what sort of happens? And I'll start, I guess the way I would probably frame this in my experience is, and I've said this before, if you owe the bank $20,000 and you can't pay, you have a problem. But if you owe the bank $20 million and you can't pay, the bank has a problem. And so I think the book went through the context that banks can't really, we talked about this in class, banks can't own real estate. The only real estate that banks can own is the real estate that they occupy. And they are prescribed from owning real estate in the long term. And in fact, when they do foreclose on an asset, there's a time window on how long they can actually hold that in their portfolio. It used to be 5 years. It may still be 5 years. I don't know. But what are called REO or OREO, other real estate owned or real estate owned apartments at banks, are workout areas. And a bank's priority or preference, a creditor's preference is always going to be to not take over an asset. That's not their business. We talked the other day about Moody's, we talked about rating agencies, and we talked about what rating agencies rate. And what they ultimately rate is a company's ability to generate cash flow to service debt. So when you look at the hierarchy or the priority of what a creditor is going to be concerned with, they're first going to want cash flow coming from an asset. Okay. Second of all, they're going to want some sort of enhancement, right? Somebody's guaranteed to make good on the debt, some sort of compensating balance, a letter of credit that's going to guarantee my debt. And then the last thing is they're going to want to go, you know, they're going to want to go after the collateral. But that's the last thing that they want, okay? So they are not going to want to go after the collateral. So I think you start with the premise that a bank is always going to try to find a way to restructure or work things out. Well, along those lines, I think maybe it's an appropriate time for me to zing the following one across to certain students in the class, and that is, let good news fly first and bad news faster. So, if you can't do your work, let your professor know. If you've got a problem with your cash flow in your building, tell the bank, I've got a problem. Don't hide from the bank, okay? Try to work it out. Try to find, listen, we're running into these problems, okay? We got a problem with our condo. A bunch of owners took out a loan because they couldn't pay the assessment for the rehab we were doing. And the damn thing's in a term now, and the work's not done, and whatever. So I called the bank. I'm not on the board, but I called the bank, and I said, look, we got a problem here. And she wasn't very kind, but I called anyway, you know, and now the president's going to go deal with it. So, but, you know, tell people, look, I had a situation. Can we work it out, okay? That's how you're going to, you know, endear people to you and find ways to solve problems, okay? Now, a bankruptcy is obviously an option when you can't meet your debt. So, but I want to talk, because a lot of terms get thrown around. People talk about insolvency, people talk about bankruptcy, people talk about I'm broke. There's a lot of different things. So there's a couple of different things that I want to. So there's a term called insolvency. Okay, that I want to insolvency, and then there's a term called bankruptcy. Okay. What is insolvency?
Your debt is too high, like you don't have the ability to pay for your debt.
You have no liquid assets.
Okay, so we're talking about one concept, we're talking about a different concept or similar concept. So,
Solution? No solution to your debt?
no solution to your debt. Okay, So,
Wouldn't one's for the lender, one's for the borrower?
no, so if you go to Merriam-Webster's, right, because you got to know what so Merriam-Webster talks about insolvency as inability to service debt or inability to pay debt. Okay, so it kind of talks to the three things that people answered. But there's an accounting term for insolvency. Insolvency means something in accounting or in business. And insolvency basically, sorry?
So when your liabilities are greater than your assets?
Exactly. So assets are less than liabilities. Because if assets equal liabilities plus owner's equity, insolvency technically means that you have no owner's equity and your liabilities exceed your assets. Now, somebody talked about liquidity. The problem with the accounting terminology for insolvency is one may be technically insolvent, but you may have the liquidity to pay your debts. You could be a bank. You may have more liabilities than assets, but you got liquid money. So you could be insolvent technically, but stay in business.
Right.
So we've got a concept called bankruptcy. Bankruptcy is actually a legal term, okay? Okay? Bankruptcy is a state, okay, in which the assets of an entity or of a party are being administered or governed by the bankruptcy court. Okay? So this is either a reality, I can't pay my debts, or an accounting term, my liabilities exceed my debts. Bankruptcy is you've gone to the courts to seek some sort of relief from this situation.
So
yes, Isabel?
So you must go to insolvency and then...
You do not, so,
next step would
but
be
they're all,
bankruptcy,
you
right?
do not need to be insolvent to wind up in bankruptcy court.
But don't you have to be that in order?
No.
Isn't it one,
You can always go to bankruptcy court.
but how do you become bankrupt then?
How do you come in here?
Yeah.
So there's two different ways. Your creditors, three creditors can get together and say, this guy's not paying us, and they go to a bankruptcy court and make a petition.
But
That's
you
one
can-
way.
You can pay though.
Well, but you're there.
Wouldn't that be foreclosure?
No, foreclosure is when you actually are trying to enforce your rights on a particular collateral that you have. So bankruptcy is there's a court system in this country, a bankruptcy court system, which governs these situations. Okay? Now, Isabel, 99.9% of the people that wind up in bankruptcy are either accounting technically insolvent or have some sort of inability to pay debts.
Yes.
Okay, so, but understand, you may not be technically insolvent and not be able to pay debts. Okay? You may be unable to pay debts and not be insolvent, or be insolvent and pay debts. Those are all mutually exclusive. Bankruptcy has nothing to do with that, but this is where you seek protection from these states. Okay? This is the doctor that solves these ills. Okay? There are a lot of different conditions and situations. There are different chapters of the bankruptcy code in this country. The book talked about Chapter 7 and Chapter 11. And Chapter 7 talks about
Liquidation.
a liquidation. And Chapter 11 talks about what?
Reorganization.
A reorganization. There are other chapters of the bankruptcy code in this country that we should know.
Chapter 13.
Okay, hopefully we don't know Chapter 13, okay? Chapter 13 deals with personal bankruptcies, okay? So we're 11 and 7 would deal with corporate. Chapter 8 deals with municipal governments. Chapter 12 deals with farmers. And Chapter 15 deals with companies that have multiple jurisdictions, international. So it's an attempt to help companies that have international operations deal with their bankruptcy in this country. Okay? What happens, let's talk about, before we get into the difference between 7 and 11, let's talk about, so, Cole, you were saying, I've got an inability to pay debts. There's a hierarchy or a preference of how people get satisfied in this country, okay? In real estate, let's talk particularly in real estate. What's common in real estate is people make loans on real estate assets. Those loans tend to have a mortgage associated with them, okay? So you've got a promissory note, and that mortgage essentially is a perfection of that security interest in which that lender is given a right to, or some sort of interest in that collateral, okay? So one, again, you've got to go to the promissory note and see what the remedies are. Typically in this country, when you don't pay a debt, you got to notify the person, you've got to give them an opportunity to correct, and you know, I'm looking at the attorney and fix, you know, their problems. And eventually when they don't, and you provide all the notices, then you can advance to try to foreclose, or you can try to exert or perfect your interest, or exercise your interest in that particular collateral, okay? Now, what people may do is, people may go to bankruptcy court, okay, to try to stall that process, okay? Because in bankruptcy court, bankruptcy law trumps corporate law. Now, it doesn't mean that at the end of the day, if you've got a perfected interest in security, you're not going to get it in bankruptcy, but now you've bought time. Now you can negotiate with people, okay? But, so a borrower may go into bankruptcy to forestall a foreclosure process. But foreclosure has nothing to do with bankruptcy. Foreclosure is just somebody proceeding against a security interest that they have in a debt that's not being satisfied. Does that make sense? We just talked about that, Yeah. Lawyers and brokers get in the middle of all this stuff. Okay. When we get to bankruptcy, there's two major paths that an entity can go through, okay? So if there's a perception that there's residual value in an asset, people are going to try to reorganize. So people are going to try to go under Chapter 11. Under Chapter 11, you typically have a couple of different courses of action. You can have what's called debtor in possession. So the debtor, the guy who owns, or the lady or the entity that owns the asset or the assets, is permitted to operate the assets. They're in possession of it, and they are able to propose to the bankruptcy court a plan of reorganization. Okay? That's one option. The other option is the judge can say, I'm not going to give the debtor that right. I'm going to appoint a trustee and let them do the organizational plan. I think, and again, I'm not an expert in this stuff, most of the time where you've got a debtor that wishes to reorganize, they're typically given at least a first chance opportunity to do so. Okay? Chapter 7, I want to come back to 11 in a second. Chapter 7 is where people don't perceive that there's a greater value in the ongoing nature of that entity or business. And they believe that more value can be realized for the creditors by liquidating those assets or that business. So there's no longer a plan of reorganization there. You typically get a trustee appointed, and there's a very quick process to try to liquidate the assets for the maximum value possible.
Is it like Sears, Payless with the open focus?
Well, Sears, I don't know that the Sears bankruptcy is final yet, but Sears bankruptcy went through the debtor in possession. So the debtor attempted to present a reorganizational plan. Now, there's I want to say 3 key parties, or maybe 4 key parties in that bankruptcy, okay? You've got the debtor, who may be the debtor in possession. You may have a trustee, if the judge is deemed that a trustee is better suited. And you're going to have a creditor committee, and then a judge, okay? The creditor committee is a committee that's formed of all the creditors in the entity, or of the asset that's gone into bankruptcy. Okay? And they provide input to the judge as far as the reorganizational plan that's being proposed. Yes, Kenny?
Is there such a stigma in the business aspect of it, of bankruptcy, as there is in personal bankruptcy? Where in personal bankruptcy, it stays on your credit for 7 to 10 years. Does that happen in business as well too?
I mean, I would tell you that, I mean, for the most part, so there's plenty of examples where there isn't a stigma. I mean, in this country, every major airline at this point has gone into bankruptcy and come out.
Several times.
But I would tell you that one of the things that people do when there's you know, any kind of corporate transaction, you do a background check on the parties that you're going to do business with, the counterparties you do business with, and to the extent that they've been involved in bankruptcy, that's probably a big stigma. Okay, that doesn't mean it's right or wrong. Good things can happen to, you know, or bad things can happen to good people. You know, sometimes people put a lot of work and a lot of capital to use on a particular asset or investment, and it just doesn't work out. So there doesn't have to be, as long as you're communicating and you're forthright. But
Yeah, it's just that the book didn't touch on that at all, so I was just curious.
yeah, but I would tell you
It
it's
seemed like it
not
was a
good.
positive thing. Like it was like you had like advantages in bankruptcy.
So I went through that.
Can
What typically, so, you know, the book talked about, so in bankruptcy law trumps contract law. So along those lines, and again, what's relevant to real estate is bankruptcy is used a lot to void leases. You know, that's contract, and the bankruptcy court can throw out leases, okay? Typically what you try to find is, and typically, look, when you go to bankruptcy, people are going to get haircuts. And I don't want to say always, but always, if there's 100 of assets, let's just assume a situation where there's no technical insolvency. Let's just say, for argument's sake, there's a liquidity crunch, okay? So the assets are just not monetizable. Okay, a lot of long-term assets. So this company has to go into bankruptcy because there's creditors here that need to be paid and there isn't enough liquidity to pay them. In theory, you should be able to go to bankruptcy court and find a way to refinance this in such a way that you pay all these guys and your equity stays intact. What I would tell you is, in most real life situations, is anytime you go into bankruptcy, you can assume your equity's all wiped out, okay? And you're taking a big haircut on liabilities. And big haircut could be secured creditors might get 20 to 30 cents on the dollar, and unsecured creditors get 0. I mean, that's going to depend on the circumstances. And a lot of times, the only way that they get their 20 to 30 cents on the dollar is by having this converted to equity. So they say, we're going to pay you back, we're going to pay you back with equity in the company. Now, the creditors committee has to approve it, the bankruptcy judge has to approve it, okay? But bankruptcy is never a win-win situation, because among other things, there's a lot of attorneys and consultants and people in the way that make money, all right?
So what do you technically say that they just converted into an operator, like solely? Because there's no equity investment, they've been wiped out. So they're solely...
So they're management.
Yeah, they're basically just operators.
They're management, exactly, exactly. But equity typically, I'm not telling you this happens all the time, but I'm telling you that this is a very likely outcome, okay? So typically what happens, look, bankruptcies don't happen overnight. They, you know, and especially in large companies, you start seeing values of bonds go down. People that specialize in restructuring start buying the bonds at low value, right? And then as a result of that, what they're looking to do is place arbitrage, and they buy debt low and then get a piece of equity that hopefully is worth a fair bit more. My only experience of bankruptcy is we bought bonds in a large landfill, 460 acres, that were trading at pennies on the dollar. And it was about to go to the bankruptcy court. And in fact, it wound up. There were certain creditors that went and took the thing to bankruptcy court, and we went to court and offered to buy the bonds, satisfy all the creditors, and we were able to get, you know, access to the title that way. So There's definitely ways to pay bankruptcy to your benefit, but you gotta understand what you're getting yourself into and what you're buying. Okay? Yes, Jeffrey?
So unlike foreclosure, like the bank will push a property to foreclosure, would a company is not necessarily pushed to bankruptcy.
So bankruptcy,
It's something you file for.
well, you can
An
file,
entity
you
would
can
file for it.
voluntarily file for bankruptcy or protection under the bankruptcy laws, or you could go involuntarily. 3 creditors can get together and go to a bankruptcy court,
That's what I mean, they can
and
push
yeah,
it
they
to-
can push you in. Now, you've got a chance to sort of, defend yourself and make things right and all that. Yes, Sam?
I was just wondering, I read some cases in the past where banks can claim your house or claim your assets. Does filing bankruptcy protect you from those claims, or would that already be stated in the contract you go into the bank? If you,
I don't know anything about personal bankruptcy in this country. I do believe that in certain states like Florida, your home, like your primary residence, I don't want to say is always protected, but it's kind of protected, and so there's, I don't know if you've got any insight on that, but Florida's one of these states where they can't mess with your personal house. Okay. Okay. There's something called debtor in possession financing. So if you're bankrupt, you typically, if you go to bankruptcy court, it's typically not because you're technically insolvent or accounting insolvent, it's because you have a liquidity crunch. So say, well, how do you fund a business? Or there's lenders out there that specialize in what's called debtor in possession financing. So when you go to bankruptcy, you immediately stop paying interest and any debt service. And the bankruptcy laws allow you to borrow additional money, and you essentially start from scratch, and you've got a priority over previous debts. Okay? There's a whole sequence, and the book talked a little bit about priorities. I don't want to rehash that, and I don't want to pretend to be an expert, but I can suggest that any secured debt gets paid first. So there's a mortgage, it's got a specific asset securing it, those things tend to get paid first. Okay? You start getting things like employee claims, government claims, taxes and things like that. And when I say employees, mechanic liens, okay, sort of get paid first. And then you start getting to unsecured debt. Then you go to preferred stock, and then you get to stock, okay? So ultimately, stock in that sense really is the residual asset. Equity is the residual that's left over after you satisfy all of your obligations. But the purpose of bankruptcy is to restructure debts, okay? And then to try to provide as much to the creditors as is possible, either under a reorganization or under a liquidation. There's something called the absolute priority rule, and what that says, it really talks about 2 things, and I think this is critical, okay? The first thing it says that no junior creditor is ever going to have priority over a senior creditor. So if you have a first mortgage, somebody who's got a second mortgage is not going to jump ahead of you, okay? The second thing that it says is no equity is going to be paid until all creditors are satisfied. That's the absolute priority rule. The book goes over that, okay? So that's important. No junior creditor gets paid before senior creditor, and no equity gets paid before before all creditors have been satisfied, okay? They go through all this deficiency claims, and I'm not going to there's no need to go into that. The only thing I do want to talk about is in this country, almost all commercial mortgages, with the exception of construction loans, tend to be non-recourse. What is non-recourse versus recourse?
Yeah, your personal collateral.
Personal liability.
A recourse loan, if you default, they can come to your personal collateral to recoup the loss?
What if it's a corporation?
They can come for corporate assets, like, you know, computers or
Okay, so-
anything.
So let's talk about,
Yeah, I mean, if they came in, like, you know, sold off everything.
yeah, so recourse is, the lender has recourse to,
These mouses, pencils.
so non-recourse is there's no recourse beyond the collateral that's been provided, okay? So, the collateral is a mortgage, you can proceed against the asset and foreclose. You can't seek any other asset. Recourse means you're providing some additional level of guarantee over and above that. What that is what you can, you know, what you agree. So recourse could be a personal guarantee, it could be the collateral of another building, it could be a line of credit, it could be some other sort of enhancement, okay? But the reality is almost all commercial loans in this country are non-recourse, other than construction loans. Construction loans are always recourse in this country. I say always. I think almost always, okay?
So they're against the line of credit of sorts?
No, there's usually some sort of personal guarantee involved, so that you're looking, I mean, that's why development in this country is done with local developers, because there's gotta be a guy, somebody's gotta be on the hook. And so you see all these institutions, all the institutions could develop, they could hire a developer, but nobody at the institution is gonna provide a personal guarantee. So they partner with a local developer, who's the guy who's gonna, in exchange for some sort of promoted structure, some carried interest, is going to sign and assume that risk. Okay? Any questions on bankruptcy?
Yeah, what is the what's the difference between like REOs and purchasing them from a bank as opposed to like purchasing a property or the bankruptcy version of an REO? So if you wanted to try and buy an asset that has been seized in bankruptcy from a trustee.
You're saying maybe buy a trustee.
No, that you would buy the asset that was foreclosed on in the bankruptcy, or taken, or seized.
No, so just stop to think about this priority rule. Even if an asset goes into bankruptcy, the secured creditor is going to be protected there. So notice we're saying bankruptcy may forestall the foreclosure, but that first priority creditor doesn't lose his priority in bankruptcy. So, your first scenario is a bank has exercised their right and has gone against property and obtained title to it, and the bank owns it and they sell it to you. That's one. Scenario number two is a creditor's gone into bankruptcy to protect a particular asset. Well, that asset right now is not really transferable. In fact, one of the things that the book doesn't go into is, and I forget what the dates are now, but most transactions, I believe it's up to 180 days prior to a filing, can be unwound by a bankruptcy judge. And the reason is because, you know, if you know you're going to file, you might pay off all your buddies, or you might do some self-dealing, or you might create some structures. So the bankruptcy court has a right to unwind transactions up to 180 days prior to a filing. But when you're in bankruptcy, you're not going to be able to buy something without the blessing of the creditor.
Like Chapter 7, like if someone was, they were trying, like the trustee was selling off the assets.
Okay, so what's going to happen there is there's going to be some sort of auction, and then the creditor's going to go to the auction and figure out whether you're going to pay them more than what they're willing. So they've got a claim, right? So they want to maximize that claim. They may be able to maximize that claim by bidding against everybody else.
Are they ever writing off their losses? Like, are they ever just like, all right, this thing is like just completely like destroyed? Not
I mean, they might, but you know. So there's a $30 million mortgage on this asset. It's in Chapter 7. The trustee goes to the courthouse. He's going to sell it. So this guy's got a priority claim of $30 million on it. I bid 10. The bank really just has to ask himself, is it worth more than 10? The bank thinks it's worth 20. What do? They bid 20, right? What do they pay the 20 with? Satisfying their mortgage. Now that, so they're not gonna bid 20, they're gonna bid, whatever, 11. And they'll keep bidding until they think there's still value for them to recoup as much as possible. Right? If they think it's worth 20 and somebody bids 20, they'll let it go.
So they're buying their own property?
Yeah,
How does that work?
okay. Somebody bids 10, the property's worth 20, and these guys have a $30 million mortgage. This guy bids 10, but it's worth 20, right? If he pays 10 for it, you get 10, and you're done. Let's say you bid 11. You forego your mortgage, you take title at 11, and then you sell it to somebody else for another 9. So now you get 20 instead of getting 10.
So it's like an active arbitrage.
Well, it is. I mean, and that's why a lot of times you're going to see that lenders actually are the prevailing winners in a bidding process in bankruptcy.
Yeah, I see it like on foreclosures. I don't really understand. Like, I guess because.
But did you understand this or no?
Yeah, but it's unusual.
Because they think there's more value there for them if they owned it, if they held it, than if they just got satisfied.
How much information is out there for an individual like me to go and auction it off? Because obviously the bank is going to have more inside information as to the cash flow, current tenant in place, and things like that. Like, is there like information available towards that besides like going to visit?
I'm going to tell you, I don't recall the last time I heard of a commercial asset in bankruptcy. So it's going to get sorted out before bankruptcy. And if you're talking about single-family homes, I don't know.
No.
I mean, get the daily review or whatever that thing's called. I don't know. I don't know anything about that stuff.
Toys R Us.
I don't know anything about Toys R Us. Okay, asset-backed securities. What are asset-backed securities? What are asset-backed securities? There's a whole supplemental on CMBSs. CMBS is an asset-backed security. What's an asset-backed security?
Securities that are secured by collateral.
That are backed by assets. Ask a dumb question and you get a silly answer.
Commercial
It
back.
was a trick question,
It was tricky. It sounds very tricky.
What color was George Washington's brown horse?
Yellow.
Big news.
Asset-backed securities are essentially pools of underlying cash flowing assets. Asset-backed securities are pools of underlying cash flowing assets, okay, in which the cash flow benefits are passed through to somebody else, okay? So there's a process where this underlying pool of assets is securitized in a way in which the benefits from those pools, from those underlying assets, are transferred to other people. I'll give you an example of that in a second as it relates to real estate, but this happens with mortgages, this happens with commercial mortgages, this happens with car loans, this happens with credit cards, this happens with student debt, okay? So that's the broad context of asset-backed securities. The history behind all this, it really started, the concept behind all of this started with the government trying to provide liquidity to the housing market, okay? So even before there were car loans and all that stuff, the government started creating entities like Fannie Mae, okay, Isabel, that would, when I know you're going to find this humorous. When I was in 8th grade, I had a teacher named Miss Moore, and Miss Moore called my mother to tell her that I talked too much in class.
Yeah,
And
Trust me.
she sat me in the front facing the class. So I think this is your just payback for those days, you know? Miss Moore is laughing somewhere because I talk so much, and she had to sit me here so that I couldn't talk to anybody. And
You
now
can
I'm
talk to
getting
everybody, that's
payback,
like the best
okay?
seat in the house.
So here's a bank,
And now you're.
and now I'm a teacher. Yeah, now I'm Miss Moore. A bank, full circle, a bank takes deposits, and makes loans. This is debits, these are credits, these are assets, these are liabilities and equity. A bank takes deposits, and makes a bunch of home mortgages. So what happens when they run out of deposits? They can't make any more mortgages, right? But the government wants people to buy houses. So they created Fannie Mae and then eventually Freddie Mac. And what this entity would do is buy the mortgages from the banks and pay the money. And now they held the assets here, they held the mortgages, and now the bank could make more mortgages, right? So now the bank can make more mortgages. And then they would repeat the process. Now eventually these people needed capital, so that's the process of securitization kind of started here, where they started saying, okay, well, we need to get some cash in, because we can't keep buying all these without equity. So they started packaging these, and I'll show you how that works in a second. And they would sell the underlying cash flow from these securities to investors in the way of what were called pass-through certificates.
Fannie Mae and Freddie Mac, again, what is the exact difference?
Well, the reality is today, I mean, Fannie Mae dates back, I don't know the whole history, Fannie Mae dates back to the 30s. Freddie Mac's like early 70s, but at the end of the day, today, those entities essentially do the same thing. They're both under U.S. conservatorship, so we own them. We own 90% of them through a big investment in preferred stock. And they do that. They buy mortgages, but they also provide financing, especially in the multifamily space. They're like 40% of the multifamily financing industry, okay? And they have other programs that ultimately foment or incentivize home ownership in these countries. So
What was the whole credit default swap thing?
it's for another day. That's for
Would you,
another day.
you said that there's like commercial-backed securities or mortgage-backed securities. You also said that there's student loan-backed securities. Would you short that at this point? Like, does that sound like a
The
bubble?
way to short all these things are, the problem is none of this stuff, all this stuff is over the counter, and that's part of the problem with mortgage-backed securities. So there's a lack of transparency, and that stuff's all institutional in nature, so I can't short student loans. And I can't buy or sell credit default swaps or buy credit default swaps against those. But those are ways to short, yes, some people would do that. Would I do that? I mean, it depends who you all are gonna vote for, because if you all vote for Bernie or Pocahontas or whatever her name is,
No, you didn't.
if you guys vote for Senator
I know
Pocahontas,
you didn't say
and
that.
they forget all the student debt in this country.
You're Cuban. You Cuban.
I am Cuban.
And you calling her Pocahontas.
But she said she was a
Yeah,
Native
she said-
American Indian.
Wait, what does him having to be Cuban have to do with calling her Pocahontas?
Because Pocahontas is kind of, if you don't get it.
No, I get it. I just don't get what you're saying. Like,
I'll skip. I want to skip a bunch of this stuff.
Later.
Listen, so asset-backed securities, they're sort of. There's a paradigm. There's some paradigm shifts that start happening over time. The intermediation process, you start getting. You not only have banks originating mortgages, but you then have, and I'm going to focus the asset-backed loan perspective to mortgages, not to other types of debt. You start getting mortgage bankers out there. So you start getting, there's a difference between originating to hold and originating to sell. And then there was issues surrounding that, and part of the financial crisis had to do with, it's hard to talk over people. Is originating, people were originating, they didn't really care the quality of what they were originating, they were just selling it to everybody. And so there's this whole moral hazard out there. And part of the Dodd-Frank bill requires people who underwrite mortgages now to at least retain. If they package, if they're just a conduit, they still need to retain a portion of those mortgages. Okay, so concept of originating to hold versus originating to distribute. The whole process of securitization brings, I'll let you read my notes, there's a tremendous amount of benefits, macroeconomic benefits, okay? Additional liquidity in the marketplace, new financial products, different matching of time, of maturities and revenue, lower cost of debt to consumers, blah, 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 blah. More fees for professional services firms. There's all these, insurance companies, that provide, that provide enhancement for these, benefits. So there's a whole bunch of macroeconomic reasons why securitization is good. There's some limits to it. There's obviously some transparency issues. There's a lot of leverage that's used. There's a lot of opacity. And ultimately what brought down Bear Stearns, which then brought down Lehman, which caused the whole 2008 financial meltdown, were these highly levered, structured finance vehicles that surrounded mortgages, okay? There's a lot of different processes in how you do a commercial mortgage-backed loan. I'm going to give you the process real quick. We have a conduit. So that conduit could be an investment bank, it could be JP Morgan, it could be Bank of America, it could be Merrill Lynch, okay? It could have been Lehman in a day, it could have been Bear Stearns. Okay, so you've got a conduit. A conduit is just a go-through, right? Go-between. So it's some sort of financial intermediary. And what that person does is they have some sort of capital base, right? So I don't even want to talk about their capital right now. It's Citibank, okay? So Citi's got, their capital stack. And they want to generate revenues, and they want to underwrite mortgages. So what they do is they underwrite a bunch of mortgages, okay? To the point where they no longer have capacity within their portfolio to generate any more mortgages. So they need to sell them so they can generate more. We just talked about that. So they'll go out here and they'll create an SPV. What's an SPV?
Special purpose
Vehicle. Okay? So they'll create, or an SP, a special purpose entity. They'll create this entity, and what they will do is they will sell, enter into an agreement to sell to this entity these pool of mortgages. This entity is going to turn around and create a series of securities, tranches, okay? And there are going to be different features associated with this. You're going to have different risk-return profiles. They might be fixed, they might be floating, some might have priorities over others, some might be interest only, some might be P&I. But this entity, this SPV, is going to issue a series of securities. And that security is going to have an interest in these underlying mortgages. Okay, now, Citi will continue to get their servicing fee. They'll continue to service it. The borrower doesn't know who owns the mortgage. Okay, they just keep sending their check to Citibank every month. But this SPV now issues these securities, so you got a bunch of investors out here. These investors pump money in here, right? So this entity takes this money and pays off Citibank. And now Citibank has cash to generate additional mortgages. It's a pretty simple process, yeah? Now, this gets a lot more complicated because there are investors out here that will buy these strips, and then they'll buy strips from a bunch of different SPVs, and they'll do what are called like CDOs or CLOs, collateralized debt obligations or collateralized loan obligations, and they'll actually just put strips from a bunch of different SPVs together, and then they'll do the same thing. The asset here will be a bunch of strips, and then they'll issue securities, okay? And then the investors pump money in here, and so these guys have a right to this strip, which have a right to the underlying mortgages. And then, if you go back to 2008, you had what were called CDO squares or cubes, right? Where this was being done 2 and 3 times over. So the little widow or orphan in Norway who bought these things had no idea what the underlying mortgages looked like. Okay, so So it could become a very nefarious, what is nefarious or whatever, bad project. But the reality is, it's all good. It's all good in its sort of base form. Okay. This can happen with residential mortgages, and it can happen with commercial mortgages. I said the commercial mortgage market's a little over $1 trillion of this. Okay. You have a couple of different players here. There's going to be a trustee, and then you're going to have what's called a master servicer in the context of commercial mortgages, and a special servicer. So the master servicer is going to deal with payments and escrows and things like that, and a special servicer is going to get involved whenever there's a workout problem or a repayment or a loan assumption or something like that. Okay, and they all work for a fee. All right. Now, with residential mortgages, this could work like this, but it could also work where to Freddie Mac or to Fannie Mae, they do the same thing. They sell a package here, and then they'll turn around and create some securities, or they'll put them into an SPV and create some securities. And so there's a variety of different ways to skin this cat. But ultimately, you're taking a mortgage and the benefits, the cash flow benefits from that mortgage, and selling it via a security to an investor. Yes? No?
Yes.
Maybe?
Maybe.
Does it make sense? Yes.
And so they can do that as many times as they can like possibly do it. Like you said, cube, that they can go past cube.
I mean, you don't see, listen, people aren't being, and the other problem is, in these entities, they use leverage here too, and you can use leverage here. So you don't have to raise as much equity, you can borrow money against it. So it just becomes that much more, house of cards over time. I mean, I think things are a little bit more stable. You're not seeing, the exaggerations. You're not seeing the exaggeration. The real problem was the original underwriting process and the risk of the mortgages that were being underwritten, right? The sort of what with ninjas, no income, no jobs, whatever. So that was kind of the problem, was the credit quality of the underlying. You never heard ninja before? Yeah, ninja, no income, no jobs. It's like. So the underlying quality of the mortgages was bad. Okay, so that was really the problem. There's a bunch of other things that happen here. There's ratings. So the Moody's and S&P rate these things. So that supposedly is an enhancement. The monoline insurance companies also can provide insurance coverage against it. But I think in 2008, there were trillions of dollars of these things insured with no underlying equity in these insurance companies. So the insurance was essentially worthless. Okay, so I want to send you all of my notes from a different class that I used to teach, and from classes that I've taken on this, and you can read them, you can go through them. If you have any questions on it, I'd be more than happy to answer them, but I'm not going to spend any more time going over securitization, other than to say it is important. It does impact commercial loans. We talked about some of the nuances of commercial loans last week, so I'm not going to repeat the whole call protection. Okay, but you're going to get notes on that here, so a prepayment, lockout, yield maintenance, and defeasance. Okay, and I talked about special and master servicer, and that's it. That's it for my notes on this. Okay, so here's what we're going to do. Here's what we're going to do. We're going to take like a 7-minute break. We got a quiz on diligence and the CMBSs. I'm sorry, and bankruptcy. And then we're going to jump to the A-class assignment for the week. So I'll be back I will hand these things out. They'll be on your desk at 3:15 at the latest, okay? So that you've got, your 15 minutes to do it. 3:15. All aboard. That's enough.
Just a public service announcement. You all got an email from me yesterday. Sign up for that webinar even if you're not going. Thanks.
Why is that a public service?
I don't know, but Fred's responsible for these performance hours also, so if you feel compelled at all to help Fred or me.
No income, no job
Asset.
Huh?
No asset.
No income, no job.
Okay.
I say ninja.
Was he gonna ask about bankruptcy?
That was a joke of the day.
You don't want you to retain it.
I worked last night.
Why?
I swear my life.
Just trying to get a little bit out of it. Trying to really get out of it.
So I don't have my mom come into my room.
She
into
puts
my
it
room
in for me.
before night. Puts it in my mouth. You ready, L'Oreal?
Definitely just be the hash.
Yeah?
Everyone like,
Yeah? Is that a real yeah?
another spreadsheet that was.
No,
Are you lying to me?
It's overload, right? You gotta,
Do you
like,
think they'll give me a ticket?
filter everything out, try to.
Where?
Like, yeah, I understand.
In the garage.
Like, for how long?
Tuesday you will, till Tuesday.
Let's find out. Let's take a bet. Wait, so why does this, real quick, why does it matter that he's Cuban in relation to him calling a woman Pocahontas?
No, listen, he's a Cuban, he's immigrant. She's native.
No, but she called herself that. Like, she
No,
basically,
no, Trump did.
but I mean, yeah, but I mean, she basically was like, I'm a native.
Yeah, but just because someone is native, you gotta call it like that.
Hell yeah.
It's Mother Earth.
I think the problem is that Americans only know one Indian name for females, and that's that.
Yeah.
So to label every person like that.
Have you seen Elizabeth Warren?
Geronimo.
She don't look at Pocahontas. You will be very to the party.
The lady that walked in
Has
the
a-
park around or?
Negative charge name, that's why.
Oh, I mean, absolutely. I mean, he's out here calling fucking Rocket Man, the guy's got a nuke. Man don't give a fuck.
Hey, Brian. It's like, dude. Brian, Carl, and.
Like today? Would you
I did watch the video. I didn't know what to do.
The last video you were supposed to be made for.
I have no idea.
But the thing is,
There wasn't a sound, just a part of the
the whole thing by himself, and he just talking all the
Did you actually end up making a platform?
Oh, I see. But
You're verifying the lease.
I still have an incomplete one from the,
I have to read complete zone that was the one from the first budget. That's still like
What are just figuring physical?
He's like, I'm moving. It's all the same about that. It is like just another thing. Are these models supposed to be built or just trying out
he said that we should know how to do this. But then again,
That's what was fast
Great, so obviously, options, it doesn't add those case one.
Mitigation, that's to be traded. Oh, no, phase two. Phase two or walkway.
What happens in phase two?
Soil test.
Right, alternatives to the contract termination. Renegotiation. Well, he said other termination, alternatives other than termination, so mitigation.
like that, because everybody here has to take it.
okay, I have taken accounting class in the
Analysis.
That's a nice job.
Then what are two?
Okay, all right, put everything away, please, phones, notes, whatever. Out of the first 14 questions, out of the first 14, pick 10. The 10 easiest. Out of the next 5, do them all. So out of the first 10, there's a line between them. Out of the first 10, just pick the 10 easiest.
Out of the first 14, pick it.
I'm sorry, out of the first 14, pick the 10 easiest. Put your notes away.
What if I want to
ladies.
challenge?
You what? Want to what?
I said you said pick the easiest, but what if you want to challenge?
Pick the hardest one.
All right.
We don't need the financial ratios or whatever, so. We don't need those notes. Look, we got people already coming up with answers, that's great. Who we got? Miriam? Brian?
Thank you.
James? Oh wow, I might not have enough exams here for everybody.
Yeah.
I might not have exams for everybody. Oh my God, I actually have just enough.
Thank you.
And an extra one if somebody wants to do two. Yes, Julie, Juanita.
Is number 3 a yes or no question?
How do you even read number 3?
Yes.
That's the answer?
No, I didn't say it's the answer. Yes. Yes, comma. It is a yes, no, true, false
I'll
type of
argue with
question.
you.
Is it supposed to
Take
say
it
would
wrong.
be a typical
Yeah,
set?
I think it's missing the B.
B is missing, yes.
And then during,
Three is yes or no.
Yes or no or true, false.
You gave the answer, guys. What are we doing?
Yes, it is a yes or no answer.
Bless you.
Bless you.
Bless you.
Wrapping up in about 5 minutes, okay? You finished? No. Oh. Four minutes.
19 and 20 or yes or no?
I think they're like yes, yes, no, or true, false type things. Yay or nay. you can't read my writing that I messed up.
I just,
It's a debtor in possession financing is subordinate to pre-filing claims.
like, I know they can, but like, the wording, you know?
Thank you. 3 minutes. It's just basically saying which is subordinate and which isn't.
Okay.
3 minutes. Filing, pre-filing.
Yeah. I would think about it.
1 minute. Thank you, folks. Thank you, Sam. And don't go, I mean, stand or whatever, but I'm gonna start right as soon as we get all the papers in, okay? Thank you, Casey. 45 seconds. Get your little red mouse
And a button part.
and a little button.
Yeah.
Make sure your name's on them.
Not sure if I put my name on my handwriting is so messed up anyway.
Thank you, Miriam. No, you did not put your name on it.
Yeah.
That means you got a 0.
Right.
Thank you, Andrew. Okay, guys, ladies and gentlemen. Thank you. Thank you, Ramon. Okay, let's go. Thank you. Thank you, ladies. Thank you. Thank you, Penny. Okay, Ram Mahalik. Thank you, James. Do I have any papers left? Okay, guys, I want to show you something. Don't pop them up. You'll pop them. Give me 5 minutes, and then you can pop them open. Okay? I want to show you guys something up here. Yeah, just give me 5 minutes. So listen, there's a couple things I want to go over. The first one is, so I've noticed generally there's been we've gotten a little relaxed with formatting over the last few days. So like names on files or names on paper, like how do I know it's your file? Names on file, names on tabs, and then just, you know, currency, just formatting. I had one the other day, had like numbers in the middle of a column. They were all currency, you know, grid lines, all kinds of stuff. So I would encourage you to maintain the rigor that, you know, we were trying to hold on to at the beginning.
A lot of people struggle with it.
The assignment last week was exactly what was on the video. It was a 40-minute video. It wasn't even a long video. It was exactly what it was. Juliana, give me a second here. Eyes here. Okay? And really, at the end of the day, it's a present value annuity. We had done this like 3 weeks before, and it's basically like an interest-only mortgage. So all I did, honestly, I cut and paste what I solved for while I was building this, and I really thought everybody's going to get like 100. And I got a myriad of responses, some of which, I don't want to go there. Some of them were very similar. That's a whole other discussion for another day. But what concerned me is that there wasn't, it seemed to me like there was a lot of slapping numbers together, as opposed to trying to understand the concepts. And if you don't understand a bond, okay, Professor, I don't understand a bond, but we need to understand how to use PV, FV, payment, and rate. If we don't know how to use those 4 things, surprisingly, a lot of you turned in your assignment without even solving for those. So I got the longhand, but I didn't get, I mean, the bulk of the thing was use PV, use FV, use payment, and use rate. And basically prove what you've done longhand, okay? It really was very, very simple. James, you're stretching or?
No, actually, I think it would help if they're actually done in class. Because trying to follow the videos at home is, personally speaking for myself, it's a little bit frustrating because there's times where you demonstrate what it does, but you don't explain how to build it to make it do what you're demonstrating that it does. And
Okay,
so,
I mean, I'll take that. The limitation I have is, and honestly, and you saw it today, is with 20 students, 21 students asking questions, and all the material we got in the plan, I'm doing the best I can. I'll stay as late as I need to, and I'm happy to, the thing I can offer, what time did I respond to you last night, Miriam?
9.
Was it pretty exhaustive? What time did I respond to you? I'll spend whatever time I can, James, and I hear you. I hear what you're saying, but there's got to be a component of learning outside the classroom here. We can't do it. We can't limit the graduate learning to the 4 hours of contact time. There's too much material. So I hear you, and I'll do the best I can. That's why I want to show a couple of things here. But feel free to send questions. Yes, Alec?
Did we ever do anything with that development budget that we saw a 20-minute video on?
Are we going to do something with it? Yes, we will.
I mean, it got halfway and then it just...
No, there was leverage overlaid on it, and I just took the leverage component and played on it this week. We're going to come back, and what the video said is we're going to come back to a development budget at the end of the program. So we're going to finish with in-place income, and then we'll go to development. What was the doubt? What did we not
Well,
get to?
jump around. I mean, it's tough to follow.
Okay.
Again, right?
Okay.
I'll trust the process.
Okay. Johnson?
No, I was just gonna, like, for some of the equations, like, example, I have it taken care of now, but like, when I'm reading the equations that are just in red, sometimes I have trouble connecting exactly because when it says like cell 32A from the equation that's there, it's hard to like know exactly which cell yours is in. You know what
So
I
you're
mean?
saying, so when you see...
When I see the equations that
When you
write
see
out,
the equation that I have, you don't see the whole thing. So
Well,
you're,
Sometimes we don't.
so what you're asking me is if I'm walking through and I've got that, point back up to it so you can see it.
Yes.
Okay, all
Yeah,
right,
that's
that's fair.
Yeah,
That's fair.
for some
That's
reason,
fair.
the most recent
Yeah.
video you can use it fixes the picture-in-picture. So like for one of them,
We couldn't see.
your
like,
face
the
was like
color.
on the cell, so you couldn't.
Yeah,
really
we couldn't see
reference
the
what
side
cells
to
was
see
talking
which
about.
cell you used, because the previously we couldn't.
I know, the
move.
problem, yeah, okay, I didn't realize that. The problem is that those are both given by the university, Kaltura, which is the one I use for the first, like, 11 videos.
I don't know, my phone started
Stopped
playing-
working and I can't get anybody
No,
here.
No, the phone started playing music.
I'm trying to get somebody to solve it. And so I'm using the other tool that they have, and so I'll try to move stuff up. So you're saying it's the lower right corner
So
what gets
it's not showing
affected?
the cells. It fixes on the, well, when I was viewing it, it fixes like in the left hand, like right where the.
Yeah, you couldn't see the bottom column that tells you the row, you could not see that. So all of your cells that are telling
Let
the
me
row.
look at that.
Yeah.
I'll look for that. That's fair. Yeah, yes, James.
Also, every time I access the video, it asks me to register.
That's.
Yeah, I can't help you, I know, I have to, listen, me
No,
too.
it sends you an email that
Yeah.
you then just hit
Yeah,
that and
yeah, yes, Jacqueline.
Well, what I was gonna say is that one thing I learned to do is to, wherever you end up, where you've zoomed out and I see the whole sheet, I screenshot it, so I can refer back to
Yeah, I
it.
mean,
Thank you for that.
she's got very copious notes
Yeah,
where
thank
she
you for that.
actually
That's helpful.
screenshots stuff and then sort of looks at it, so.
Well,
one
I
second,
paste
Kenny.
it in so I can see.
Kenny,
Yeah.
It's possible to do Excel here and the lecture online.
Yeah, I would much rather listen to current events on video.
No, that wouldn't work.
Okay, I have one question. So, you know,
What?
the first few classes, I know you were trying to show us.
I need a question,
Okay, I'm
because I'm getting antsy that I can't get to the material.
Oh, okay, what? I don't know.
Okay. Listen, so this was a longhand, this was a longhand of the bond, right? $100, 8%, 8 years, interest only. Okay, 4%, right? It's payable semi-annually. We solve for the $2, 102 at the end, okay? And then, listen, and most of you were able to get to here. Most of you were able to get to solving it with PV and NPV. Okay? Now, for some reason, then the wheels fell off afterwards. Then people started doing 2 of these.
Yes.
I don't know why. The coupon that a bond pays, the interest rate that a mortgage pays, doesn't change.
But you said do 30%. Yeah.
I said to solve for payment. I said solve for the present value. Solve for the present value at 8 and 10. Okay? And then down below, solve for. So these 2 should equate what you solved for up there. You've already got them. So if you get 89 longhand here and doing MPV, if you get 89 here, and when you solve for it with PV here and it's not 89, you got a problem. So, but we got to stop and think sometimes. Okay, let's stop to think. The coupon is 8. The coupon is 8. The market value is 10. For me to earn 10% on a security that only pays 8%, I got to pay less than 100. So if I come up with a solution that's like $430, something's not right. Right? I mean, the other way to sort of prove this stuff is because you could have used the same table that you built longhand, right? Put the present value here, right? Put the present value, you know, you could solve for present value. Here, present value, right? I gave you the 100. I told you so. So if I put 89, let's go negative, right? Let's go negative, actually. We should be able to do an MPV here, right? At the 10%, right? And it should give me 0, right? Isn't that what MPV and... Oh, hold on. Oh.
Excel is so sensitive too.
Yeah, I know. Sometimes you do these stupid things. Hold on a second. Oh, I know what the problem is. Hold on. That's what happens when you do things crazy, right? So the interest rate is, what's the rate? So here, I always encourage people, open up the boxes and figure out what it's telling you, okay? What's the rate? It's 0.5, but it's payable semi-annually, right? So divided by 2, okay? And here's my value, and it should give me 0. What is it doing?
Don't you have about